Good morning. It is 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Julie Hyman with Brad Smith, and here are three things you need to know this morning. Fresh inflation data will be the focus this week. Wednesday's June CPI report is expected to show the index rising at its slowest annual pace since March 2021, though it's unlikely to move the needle on what's seen as a surefire Fed rate hike this month. As usual, sticky core inflation will grab most of the attention. The release will be even more closely watched after a cooler than expected payrolls report last Friday. Earnings season returns, and the first reports from the banks will provide another window into the economy and their willingness to lend. JP Morgan, Wells Fargo, Citi, BlackRock, they all report on Friday. Analysts at JP Morgan actually prefer European lenders over their U.S. counterparts going into those reports. Overall, Goldman Sachs strategists expect U.S. companies to be able to meet what they're calling a low bar for numbers. The signs have not been great going into the reports. FedEx, ExxonMobil, Nike, all casting doubt on the health of the U.S. economy in recent weeks. And U.S. Treasury Secretary Janet Yellen tones down talk of decoupling as she wraps up a trip to Beijing. Meeting with China's newly appointed economic team, Yellen reassured leaders the U.S. is not focused on gaining economic advantage, but made clear that one meeting wasn't going to solve the challenges. Much of the trip was framed as a fact-finding mission, notably on the health of the world's second biggest economy. Fresh data this morning showing deflation is now a very real concern for policymakers. Just making sure we know it's deflation and not the opposite, which is what we're coping with here, obviously.
Well, that opposite being consumer inflation, and that data and the start of the second quarter earnings season will set the course for markets this week. On Wednesday morning, investors will get the latest print on consumer price index for June. CPI data is expected to show a continued slowdown in inflation pressures. Wall Street expects headline inflation rose 3.1% annually last month, a slowdown from the 4% rise seen in May. On a core basis, which strips out food and energy prices, CPI is expected to rise 5% over last year in June. That's a slowdown from the 5.3% increase seen in May. Here to weigh in, we've got Peter Chur, who is the head of macro strategy over at Academy Securities. Peter, great to have you here with us this morning to really kind of kick off some of this inflation data that is set to come this week and the expectations that perhaps some of the inflation pressures are continuing to ease here. So where and what particularly in the data would you be looking out most closely for?
You know, I think we are going to see sticky inflation be the problem. We're seeing goods inflation generally come down. I think that continues. I think supply chains are no longer a big issue. So look for some, relief there in auto prices, things like that. And we'll see what happens really in hospitality inflation and service inflation, right? I think there's signs that could start slowing. It's probably not going to happen and the reality is I'm hunkering down for a 3 to 5% inflation prints for the next, 6 months to 2 years. I think it's going to be very difficult to get it below 3%. It's not going to go back above 5% anytime soon. And that's what's going to allow the Fed to be very slow playing on this data. So it's not going to be as important each individual print as it was in the past, as the Fed is now on a very level playing field, I think.
At the same time, I mean, if you're expecting, Peter, the inflation numbers to stay 3 to 5%, that's still above 2%, which is the Fed's target. So do you think we're actually only going to get a couple more increases? Do you think we're maybe even actually lowballing the number of hikes that remain?
No, I think we'll get this one in July, and maybe we get one in September, one in October if we stay above that 3%. But I think they're going to be they say 2%. I think they can't change their official rate. I think behind the scenes, they're somewhat comfortable with 3%. And they're also going to want to be very careful about hiking too much into an election year, right? You can go back to what happened to George Bush Sr., where he had these great approval ratings, then the economy tanked, and his renomination or reelection failed. So I think they're going to be really careful. They're going to stick to this. Hey, we've hiked a lot already. Let's see how this plays out in the economy. There's signs of easing. There's signs of pressure of the economy. So let's just keep it stable. So I think maybe we get one more hike after the July. And I do not think, though, we get any cuts at all.
At what point in the kind of inflation prints that are set to come over the course of the Fed's continued policy here, where Fed Chair Jay Powell has already said that we could still be looking at consecutive rate hikes at future meetings now, at what point would it be clear within the data that we're looking through that they are able to achieve perhaps a soft landing that they've continued to talk about?
I think if we see this kind of slowing of the inflationary pressure, which we've generally seen. It's going to go up and down a little bit, but this trend is a little bit better. And I think there's just enough data points offsetting, right? If we start getting where every single bit of data looks weak or every bit of data looks strong, we're going to have to offset that. Again, the jobs number itself was weak, but average hour earnings were high. So there's just enough, I think, to keep them on hold. And it would really need consistent data that's extremely high or extremely low to change that kind of baseline they've set for us.
If we are going to see these two increases and then sort of have that status quo, right, and persistent inflation, what does that setup look like for equities?
I think really it comes down to equities. Good news is going to be good news. Bad news is going to be bad news. The Fed's not going to be manipulating or influencing markets quite as much. So I think earnings are going to be even more important this season than they've been last season or any other time recently. It's going to come down to individual stories, how companies are doing. And we're going to start watching, I think, more and more of how is the U.S. consumer doing? I think the consumer has been the strong point. That's been the shining light in the economy. There are some signs that it's been weakening a little bit. You're seeing delinquencies tick up, not alarming rates, but higher. Credit card usage going up. We don't know what's going to happen to spending once you start seeing consumers people having to spend their money on their student loans. So I think the consumer is going to be a big focal point for driving the economy as well.
You mentioned something really interesting. I was going to ask a totally different question, but the second you mentioned student loans, I don't know, my blood started boiling as a person that still holds a significant amount here, Peter. So that considered, we've heard some calls on the street talking about where student loans have a broader economic impact once those resumes. Perhaps you could flesh that out again, just a little bit more here for us.
So I think the impact's not going to be as great. I think one thing that happened is a lot of people, whether it's on the loan front or on their mortgages, anyone who had these deferrals, I think they did a good job of setting money aside in their bank accounts, knowing eventually these payments were going to come out. So what I'm really looking for is excess savings to come down a little bit further and more rapidly as people start spending that money to meet their obligations. So I don't think it's going to be a shock. I don't think we're going to hit like this, brick wall in terms of consumer spending. I think it's going to be a minor slowdown. I think people were prepared for it, a little bit disappointed. And maybe what you're seeing right now in the travel and leisure is that one last gas. Hey, we've got the extra money. Let's spend it now because we're going to have less going down the road. So I feel it's like a headwind, only a small headwind, and definitely not going to be something that shocks the economy.
All right, Peter, stay with us. We got much more coming your way, starting with this. It's the first day of second quarter earnings season. Investors are going to be watching companies closely to see what their results say about the economy, consumers, and more. Brian Sozzi laid all of this out in today's morning brief, how Nvidia may have set the bar too high for this earnings season, pointing to a recent note from Evercore ISI strategist Julian Emanuel saying, quote, the bar has been set high for second quarter of 2023 reporting season as blockbuster May 24th results from Nvidia have catalyzed upward earnings revisions for the growth-heavy Nasdaq. The chip giant set its second quarter revenue outlook at $11 billion. That was way above analyst expectations, remember, of $7 billion. And that news at the time sent the S&P 500 skyrocketing up over 7% in the last 3 months. And Saz is now
I think you said it perfectly, Julie. I'm nothing. What else do you have? What other tickets you want to talk about? But no, I think that is the gist of the Morning Brief newsletter, and it just hit our homepage this morning. I encourage everybody to check it out. But really, Nvidia shocked the heck out of the market on May 24th. I've been doing this for about 20 years. I never saw a type of guidance raise like we saw out of Nvidia, over $4 billion in upside in terms of revenue versus where the street was, a complete resetting of the bar. And I think what Julian here, a friend of our show, was just on a couple weeks ago, is arguing here is that more investors are thinking other companies are like Nvidia, and they're going to come out here and they're doing various things in AI, and they're going to see massive revenue upside. But hey, I mentioned in the brief, I went to Home Depot for a new barbecue brush over the weekend. They're not selling AI chips. Berkshire Hathaway not selling AI chips. And I think you look at the note out this morning from Goldman Sachs, the S&P 500 is still expected to see year-over-year earnings decline by 9%. Sales growth, there is not going to be any year-over-year sales growth for the S&P 500. That would be the first time that has happened in the past 10 quarters. So not every company is like Nvidia. Not everybody's selling AI chips, and I think that is very important to keep in mind.
At the same time, let's not pretend that earnings are actually going to decline by that amount.
Oh, you're going to strip them out. You want to?
No, they're always wrong.
Well, but still, we're
directionally, perhaps.
You're supposed to be big declines. You're looking at energy down maybe 50% year
There
over
were
year.
supposed to be big declines last quarter,
Materials down 27%.
There were supposed to be big declines last quarter. What happened to those?
Look, Oil prices are about $73 a barrel. Energy companies, sure, maybe they don't hit a 50% year-over-year decline in earnings, but earnings are likely to drop. Even if they get a 25% drop, that is huge, and definitely not an Nvidia story.
Well, yes, likely to drop, but at what comparison? Are we comping year over year, or are we comping what companies have actually said? Because the executives themselves have had the tendency, at least historically, to sandbag some of those figures.
All I am saying with this newsletter here, guys, wow, talk about this pushback here on a Monday morning. Nvidia is not the normal company. So if you're coming into this earnings season thinking a lot of these companies are profiting and cashing in on the AI boom, that's not going to happen. Now, will we hear good things from companies like Nvidia, AMD? Maybe they come out there with their own guidance reset because they're seeing demand for some new AI chips they put out. Do we see a guidance reset from a Salesforce, which is now standing up various AI applications and instances? Maybe, but those will be not the norm.
Okay, that's fair.
Fair.
So let's put this question to our guest, shall we? Has NVIDIA's AI hype spoiled investors heading into the second quarter earnings season? Peter Chur is back with us, Academy Securities Head of Macro Strategy. So Peter, I'll ask you very simply, how bad is this earnings season going to be?
I'm not sure how bad it's going to be. I think it's going to be a little bit weak. Going back to the question about Nvidia, you can look at even Microsoft. Microsoft added almost $1 trillion since its January lows in market cap. Nvidia added $700 billion. So yes, great earnings. But I think one of the questions is, okay, are the valuations even ahead of those great earnings? So you've had this massive rise. The one thing that I have not seen with AI is you're really not giving any benefit to the companies who are supposedly going to use AI and get these efficiencies. At some point, if AI is really going to take the world by storm, I think you have this ability for companies to show efficiencies. You get to see real growth. But I think right now they're going to have to spend money to get there. So I could see some earnings weakness across the board. I think you're going to see a little bit of tentativeness from companies about consumers. And I think that's going to be what raises this headwind, because typically, yes, companies have massaged markets and analysts to the point that they beat. But I think it's going to be this story about the U.S. consumer, what's going on there, and global growth.
Peter, do you think that is where we will see the negative surprises? Are you concerned about a Target? Are you concerned about a Walmart, how they might report given consumer weakness we have seen? But as you mentioned before, that potential headwind with student loan repayments.
Yeah, I think it's going to come from the consumer side. I'm going to watch carefully on the auto side. If you go back a year ago, all you got was emails, or at least all I got was emails, them trying to buy my used cars. Now I'm getting ads for getting new cars from them, right? Oh, discounts are coming back. So I'm not sure. We kind of got this pounded in our head. Automobiles are impossible to buy. You can't get them. Is that starting to tilt? So I think it's going to be across the board. And the one thing I do think we tend to all forget is a lot of people have 3-year leases on their cars, or longer dated loans, and those are starting to reset. And as more and more people reset, they face like, wow, what used to cost $500 is going to cost $800. So I think we're right in the midst of that. And that's where you're going to see the consumer pulling back, on addition to everything else that's facing them.
Peter, as Saz was mentioning, you can have an AI conversation that is viable and it makes sense when you're talking about a company like Nvidia, but not the same at Home Depot. There's no AI chip lawnmower. I think we can all agree that that should be some type of future that we all hope for. But at the end of the day, when you think about what the magic word has been for last earnings season in AI and artificial intelligence, is there a magic word that companies can use or that you expect them to attempt to lean into this earnings season?
Yeah, and I would actually say we kind of view, when we're thinking about corporations, say a Home Depot type company, there's 3 ways that they're going to ultimately use AI. One is in their strategic planning. How do they use it to become better at strategically planning their purchases? What's going on? How do they manage their company? There's going to be some tactical level. How do they manage their individual stores better? How do they manage their workers better? So I think those are the benefits that can accrue relatively quickly. But over time, it's going to be this big spend. You got to get your data in. And when we talk about this, I think Levi said it great not too long ago. They said they are a software company that happens to sell jeans. And I think more and more companies have to think about themselves as an information technology company that sells X, Y, and Z. And yes, they are going to figure out how to incorporate AI into some of their products. Look at what Deere has done in some of their, big harvesters. It's amazing, the technology that's there. But ultimately, AI, the benefits are going to come from better management of your strategic vision, better management of your employees. And some of that's already occurring, even with the simple level of AI we have, let alone where AI should be in 2-3 years.
So AI aside, is there a magic word then this earnings season?
I think it's that you've seen that your customer base is very resilient. You're not seeing any signs of slowdown, because it's all going to be about your selling right now. And go back, say, 6 months to a year, if you talked about your supply chains being okay, that was enough. Now it's not about supply chains. It's now, are you able to sell your products, and at what margin are you able to sell those products? And I think that's going to be the risk.
All right, Peter, stay with us. We've got much more to discuss this morning here, as well as Brian Sazi, our own executive editor here. China's latest economic data is spurring concerns around deflation risks and raising questions about the need for economic stimulus. Now, the country's consumer price index stayed unchanged from a year ago and saw its factory gate prices slip at the fastest pace since 2016, marking a demand slowdown. Peter Chur, who is the Academy Securities head of macro strategy, back here with us alongside Yahoo Finance's Rick Newman. Great to have you both here with us. Peter, as we kind of kick off this discussion, in the data that we've seen come out of China, what's been most surprising to you at this point, and where are you perhaps expecting some shifts?
I'm not really that surprised. I think there was a lot of hype about the reopening. China wasn't going from 0 to 100. They were already largely open. And I think what we're really seeing right now is just more and more confrontation, whether it's on the chip side. I think last week they refused to export to key rare earths or critical minerals. We've announced that we're going to use the National Defense Production Act to supply ourselves with those, or maybe even start producing them. So I just see friction at a very high level. And the one trend that I'm seeing, though, is I think they are going to use the yuan more and more. They're going to get more countries trading with them. And you're going to start seeing a push for Chinese manufacturers to sell their products globally, rather than China just making our products to sell globally. I think that's the biggest shift, is what we're calling this, going from made in China to made by China. You're seeing it. BYD is setting up a factory, which is their EV maker in Brazil. So they are going to go after, I think, our customer base globally. And that's going to be a risk. It doesn't play out tomorrow, next week. But I think 2 to 3 years from now, we'll all look back in hindsight and say, wow, we should have fought this better.
Peter, I want more from you on that. But first, I want to go to Rick, because, Rick, I'm curious your impressions here of, giving Janet Yellen perhaps a grade as to what was accomplished here, which doesn't seem to necessarily have moved things forward, but it didn't seem to move things back either.
Right. I think Washington and Beijing are in what's going to be a long process of sort of repairing relations. We've been going backwards in a lot of different ways. There was the Chinese spy balloon. Remember, Secretary of State Antony Blinken, he canceled a trip that was supposed to happen right around then. Go back to last fall when Biden imposed these very strict advanced semiconductor limits on exports to China and keeping American technology out of China. So, the sort of messaging from the Biden administration before this was low expectations. We're not trying to achieve a massive reset here. We're just trying to basically restart dialogue and find areas where we can cooperate with China, because there are a lot of areas where we are in conflict or in confrontation with China. So finding areas of cooperation. John Kerry, the climate envoy, is probably going to go to China next. That might be something where the United States and China can cooperate. So they're just going to try to figure out where they can find a little bit of common ground.
If climate, then it sounds like a lot of the EV companies we talk about, Rick, should have something perhaps to look forward to or hang their hat on there, especially given the multitude of them that have tried to plant some type of factory production or just annexation into China through their sales or vehicles that have done well here in the U.S.
There is a lot going on here, and I saw a report recently from Morgan Stanley saying we are actually going to start seeing a fair amount of Chinese-made electric vehicles in the United States at some point. And the reason that's important is that they are going to be way cheaper than anything made here in the United States. So we know that the Inflation Reduction Act from last year, tons of incentives for investments in electric vehicles and everything associated with electric vehicles, especially the batteries. But China leads on electric vehicle batteries, and importantly, they have a lot of the components for those batteries homegrown in China, whereas we do not here in the United States. So China already has a considerable lead on electric vehicles and a lot of technologies that go with it. And we are going to start seeing some of that stuff, or more of it, I guess I should say, showing up here in the United States.
And Peter, this goes directly to the point that you were making about China, instead of just manufacturing things for American companies, is going to start exporting more of its own brands to the West. Do you think that EVs are among that? Are you counting those among that? I mean, is it too early as an investor to start looking at those opportunities? And then finally, sorry, a lot of questions in one, do you think it's going to work? Do you think there's a market for this stuff?
Yeah, so I start with basic premise that right now China has jumped the gun on us and they're way ahead of us in terms of securing these rare earths and critical minerals. So they have that. That means they tend to have these trade deficits to a lot of autocratic, resource-rich nations. They're generally poor. Let's say a lot of the emerging markets countries. So I think that's where they're going to be able to have a lot of success selling their EV vehicles, for example. Even the Chinese aircraft manufacturer finally had their maiden flight. It was a domestic flight, but they will start looking to sell those aircraft globally. And they're not going to come to the US first. We're going to want to drive Teslas, Rivians, Fords, GMs, you name it. But I think in some of the emerging markets countries, the pitch of, well, here's your BYD or some other Chinese brand. Yeah, it's not as nice, it's not as good, but it's only cost 40%. That is going to do very well. And that's why it's so important that China's developing more and more trade in yuan. So I think it will work, but they're going to make inroads starting with the emerging markets and working their way up. And that's something we're going to have to aggressively compete with.
Hey, guys, just a reminder, Warren Buffett invested in the Chinese EV company BYD years ago. So this is not a new idea.
Yes.
Yeah, and I guess the one thing that made me smile when you asked. Yeah, and the one question I think I had when you asked, made me smile was like, do you invest in these Chinese companies? And I think that's very difficult because I think China does not care about U.S. investors. So I think it could be a detriment to U.S. companies. I think it's going to be very difficult to succeed as a Western investor in these Chinese companies, whether they create new share classes. I mean, I'm very dubious about that. So I can see this direction those companies are headed in, but I won't touch them because I'm very concerned about the ability to actually monetize that view.
Very interesting. All right, hang on, both of you. President Biden is saying not so fast as questions surrounding Ukraine joining NATO arise. The president told CNN over the weekend that having the country join the alliance would be premature amid its ongoing war with Russia, saying if the war's going on, then we're all in war. Peter Chur is still with us, Academy Securities head of macro strategy. Yahoo Finance's Rick Newman are still with us. I've also been seeing some reports this morning, guys, that the president of Ukraine might actually be going to the NATO meeting in Lithuania. So obviously Ukraine is going to be a huge topic of conversation there. Peter, I want to take you first on this because I know you have some members, some retired members of the military on the board of your company. So I imagine this is a big topic of discussion for you. What are some of the things that we should be watching for going into this NATO meeting?
Yeah, so Academy Securities, we're about 50% staffed by veterans, but we also have what we call our Geopolitical Intelligence Group, which is 17 retired generals and admirals. So they serve on a lot of this. And we don't see any way that Ukraine joins NATO. If you take a look, even for Ukraine to join the EU, I think they only meet 2 out of 7 qualities, right? There's still a lot of corruption. There's a lot of negative things about Ukraine. So I don't think NATO's prepared to step up and have this. There might be much bigger promises about future invasions and things, but I think the pressure, though, is mounting on Zelensky to come to the table and form some sort of truce or peace agreement with Putin. And we see it from our side, I think, where we're supplying the weaponry. The problem that doesn't get enough attention, I think, is Europe is dealing with this influx of refugees from Ukraine, and the longer they are outside of Ukraine, they start putting their kids into local schools. They start developing ties to this new community. It's much harder for them to move back to Ukraine, especially if their house is, bombed out, if you've got infrastructure issues. So I think you're going to see a lot more talk and trying to convince Zelensky to say, hey, Putin, we can come to some sort of, peace, truce, stalemate on this thing and move on because it's good for both countries. And so there might be some support to back Ukraine a little bit more, but definitely not NATO.
Rick, is there an overwhelming response that we've heard from other countries going into this meeting and with this potentially on the table?
Well, I have a little different view on this. I think one of the things that is at stake here is the message to Putin that comes out of this meeting. And nobody thinks Ukraine is going to join NATO anytime soon. The way Biden has phrased it is Ukraine cannot join NATO until the war is over. So an important question is will NATO basically come out and say that on a united basis at this summit? And if they don't, if they sort of just give Ukraine the hand, that is going to look like a win for Putin because it's going to look like NATO is kind of turning a shoulder against Ukraine. On the other hand, if NATO says, yes, we see a path forward for Ukraine joining NATO, here is the path. And it's going to start with ending this war. that would bolster Ukraine. And by the way, I'm not so sure that there is mounting pressure on Ukraine to make some kind of deal with Russia. I mean, look, Russia is still sending missiles and drones into cities all across Ukraine. I mean, they're bombing, apartment buildings and schools still. There is no way Ukraine is going to agree to anything. You do have to start thinking about how does this end. But this, this so-called counteroffensive that the United States and Europe have been arming Ukraine for is just getting started. And I don't think you're going to hear any public pressure on Zelensky to say, make some kind of deal with Russia, because that would just undermine what they're trying to do with this counteroffensive. They're trying to, retake territory and dislodge Russia from eastern Ukraine. So this is going to play out for some period of time, for sure.
Peter, from an investment perspective, do you think that most of the sort of NATO, Russia, Ukraine risk has been priced into the market here, or is there some sort of risk that we still need to be watching for?
Yeah, I think the bulk of the risk has been priced in. I think what we not priced in is if you get some sort of retaliation from Putin or the Wagner Group resurfaces with something bad to do, right? Because it's that whole thing played out very weirdly. And I think the sad part of this, though, is, when we had the Wagner Group marching on Moscow, allegedly, it was like, oh, maybe we could get peace. Maybe Putin will have to back down. And the realization I think I had is it doesn't really do much for markets at this point. It's the way we are trading global energy is never going back to how it was pre-invasion. Russia is going to never go back to selling a lot of cheap energy to Germany. They're going to sit with their new client base, which is India and China. So I think even if we get some sort of peace, it's not this huge rebound for the global economy. I think it'd be good for Europe because you'll do a lot of rebuilding in Ukraine. But I think right now there's this little bit of tail risk that doesn't get priced in. But unfortunately, this is just the status quo, and even peace isn't going to result in a big, tick for stocks, which would have been very different a year ago, right? A quick war that ended peacefully before all these new trade supply chains had been set up. That would have been good for markets. Now I just think it's a non-event, unfortunately.
Yeah. Peter?
Hey guys, one last thing on energy. Let's go back to China. One of the reasons that oil prices are comfortably relatively low, around $72 a barrel, and gasoline prices are around $3.50, is weak demand from China. That's a huge factor in energy markets right now, and that directly affects Americans. So keep an eye on the Chinese economy with that regard.
Yeah, most definitely. Guys, thank you so much. Peter Chur, Academy Securities Head of Macro Strategy. Thanks for hanging out with us for so long. And Yahoo Finance's Rick Newman. Thanks as always.
Bye, guys.
Thanks a lot. That was fun.
Thanks. We got much more markets action coming up ahead. Stay tuned. You're watching Yahoo Finance.
The 2023 recession, canceled or delayed?
Canceled. Absolutely canceled. Just this past Friday, we got another confirmation that the U.S. economy continues to add jobs. And it's hard to see a recession without a downturn in the labor market. And we also recently learned that there's still 9 million job openings in the economy, and that amounts to about 1.6 job openings per unemployed person. So there's an incredible amount of demand for labor, and without that demand evaporating, then I don't think we get a recession.
just had the opening bell on Wall Street a moment ago. So let's do a quick check of the market, sponsored by Tasty Trade, as we open up here on this Monday morning after a holiday-shortened trading week and ahead of inflation data midweek. Ahead of a lot of earnings reports, we're not seeing much movement as of yet. Looks like investors kind of sitting on their hands until we get all of that information. All three major averages are up, but just a wee bit. Let's get to Brad Smith over at the Interactive to dig under the surface to see what's going on.
I'm diving deep. I'm mining for these numbers under the surface, and first number that we've got for you, pretty surface level as of right now. Dow Jones Industrial Average, you're seeing that up by about 0.2%. Let's give you a little bit more context here as we have kicked off, as of last week at least, the third quarter of 2023. Feels weird to say that. Dow Jones Industrial Average, though, that's up year to date by about 2%. We'll be generous and round that off to Nasdaq Composite. That, of course, has been the outperformer for the tech-heavy average that has seen a bounce back in some of these large mega-cap tech stocks. So year to date, up 30%. However, here today, flat just barely to the upside. S&P 500, you're seeing that with some minor gains on the day. It's up by about 0.1%, and year to date, you're seeing some of those gains there. Speaking of the S&P 500, let's take a look at the 11 sectors of the index here, taking a look at some mixed activity right now. As of right now, XLB, materials, you're seeing that pull up the caboose. It's down 0.3%, but leading the pack, you've got industrials. We don't say that too often here. We're seeing that up by about 0.5%, as well as staples up 0.5%. And so more leaders than laggards right now. We're also checking in on those mega cap tech stocks as well this morning, just to see how we begin this new trading week, again ahead of earnings season. As of right now, you've got some of those mega cap tech stocks moving lower here. However, take a look at Meta. Still a lot of conversation over the weekend, perhaps permeating around Threads. It's, I don't know. They're not calling it the Twitter killer, but at least a lot of people are discussing it as if Threads will be a Twitter killer. But you're seeing that up by about 2% out of the gate this morning.
Yeah, a lot of people signed up for the thing already.
I did.
Yeah.
Where are you? I have not found you yet.
I haven't signed up yet. I was on vacation last week, so I wasn't signing up for new social media.
That's wise. That's a good move.
Yeah.
Good policy.
I was trying to step away from the phone.
I like it. Unplug.
Yes. Icahn Enterprises climbing higher this morning by 12% after Carl Icahn reportedly finalized amended agreements with banks that disconnected his personal loans from the share price of the company. That's according to the Wall Street Journal. And this follows on a short campaign, short seller attack, basically, you could call it, from Hindenburg Research that, among other things, highlighted the interconnectedness of Icahn's own personal finances with that of the company. So the Journal is now saying that these amended loan agreements have maybe helped alleviate that particular source of concern for investors.
Of course, any of the moves within Icahn's own portfolio have the propensity to move some major holdings within that portfolio, given some of the campaigns that he's had in the past on an activist basis, or just anything that he could say about a company on a given day. But there's been a lot of focus on this specifically. You're taking a look at the past 3 months for Icahn Enterprises, down by about 37% over that time.
Yeah, because of that short report, if you will, and short interest in the company. Let's also talk Cava this morning. Cava Group, the company emerging from its quiet period following its initial public offering. That means that we've got a bunch of analyst initiations. Piper Sandler, Jefferies, among those initiating coverage on the quick service chain with a buy and an overweight rating, respectively. And looking at some of the other calls out here, it looks like JP Morgan also initiated with an overweight, and it looks like Stifel, did we talk about Stifel, has a buy rating? Citi, it looks like, is the only I see listed. Bloomberg compiled some of these. That's the only one that has a neutral rating here. But the way that this works, for those who don't know, is when a company has an IPO, they hire banks to help them do the IPO, to underwrite the IPO. Then following the IPO, those banks are not allowed, their sell-side researchers are not allowed to initiate coverage of the firm within a certain period of time following the IPO. So that's where we are, and that's why you now have these initiations.
Yeah, we've been tracking Cava closely going into and now even after its initial public offering, and now comes the marathon, of course, that just never really ends. But for Cava, you've been taking a look at shares. Of course, they came in and ended their first trading day as a publicly traded company well above, almost double what they had set forth as their pricing. And then since then, there's been more of this appetite, pun fully intended, I guess here. It's Monday, why not? We got to kick off the week somehow. For investors to look at this as another lunch or perhaps even dinner type of play, and that throws them into some of the same conversations that we've had around a Chipotle even. Right. And so if there is that type of multiple that investors continue to look at this with and see some type of growth potential to really get into at least the weekly cadence of purchases like they do on a Chipotle, then Cava perhaps sits in some good company there.
Yeah, I mean, and that's one of the phrases that the Piper Sandler analyst brought up. They said many have dubbed it the Mediterranean Chipotle. If you haven't been to Cava, that pretty well captures it. They said that does set a high bar. Andy Barish, friend of the show over at Jefferies, talked about the blue sky scenario, if you're comparing it to that of a Chipotle, would be a total addressable market of 7,000 units, which is what we see for a Chipotle. I mean, that would be kind of the utmost scenario. So I mean, we'll see what happens.
And it's totally right. What has Chipotle done? They've set the model for how consumers are looking to be engaged with, especially beyond just this fast food service that McDonald's, Wendy's, Burger King, all the Yum brands and so forth have been able to move forward with. They're now, because of what Chipotle has set forward, it's a different type of customer interaction. They want to know that the food is fresh, that there is nutrition behind what they're eating as well. And so in that flight towards nutrition, Cava has positioned itself even within that. As Chipotle had really set that model, Cava has been able to then kind of annex themselves to that broader way of thinking for consumers and now for investors as well.
Yeah.
Let's talk a little Fisker here, a company you can't really eat. But here, chew on this. Fisker shares are higher today after announcing its plans to sell $340 million in convertible debt with an opportunity for that amount to double to $680 million. Now, shares of the EV maker, they're actually up right now by about 1.75%. They're down over 15% year to date as we've been tracking that. Take a look at that 2023 year to date chart. And it's been interesting for Fisker and a lot of the other EV plays right now. If you're kind of comparing Fisker to the rest of them, Fisker has underperformed. However, I think going forward, there's going to be more capital that's needed to advance some of the production and bring more models and vehicles to the market as well, in a competitive landscape that is ramping up so much of those production targets as well. Yeah,
well, Fisker only just now delivered its first cars, so it's just at a totally different space than the other companies. I believe it came public through a SPAC, and so now it's trading at, you know what, well below $10, which is where you get that reference price for SPACs here. So Fisker trading at $612. So even though it is seeing a bit of a bump today, it's seeing that bump from a pretty low base here. And the company is trying to make this fresh start, as the Wall Street Journal put it in a piece looking at the company. You know, I think what it's going to cost and how successful they're going to be, investors are still undecided.
Yeah, we got a ton of production and delivery numbers last week from major automakers. Of course, Fisker trying to catch up to those, as you mentioned, but they are even behind some of their own production targets as well here. And for their units produced during this year, at least in the second quarter of this year, 1,022 units produced as of that quarter. So we'll see how that ramps up in the third quarter of 2023. Everyone stay with us. We've got all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
All right, the number one question that your readers are asking you right now as we sit here, July 2023.
It's the same question. All
right, we're good.
Hedge funds have gone bearish on the dollar for the first time since March, according to Bloomberg. Leveraged investors have now flipped to a net short position on the U.S. currency in the week ending July 7th. Joining us now to break down this is Yahoo Finance reporter Inez Ferre. Inez, great to see you.
Yeah, Brad, that net short position that you're talking about are 20,091 contracts for the week ending July 7th, as you just mentioned. And this is a reversal from the prior week where there was a net long on the dollar with 5,195 contracts. Now, why the change of sentiment from week to week? Well, this comes after the jobs report last week coming short of estimates. And if the labor market is softening, then the Fed is getting closer to where it wants to be, and the expectation is that the Fed would start easing sooner rather than later, and that's why you have these hedge funds betting short on the dollar, that the dollar will go lower. Now, if we take a look at our Wi-Fi interactive board, you can see right now the U.S. dollar, the DXY, the DXY, and this is the dollar against a basket of other currencies, especially the euro. Look at this. It's at 102.35. Year to date, it's been on a downward trend starting in 2023, down 2% year to date. And this has really supported equities because if we remember last year, we saw the U.S. dollar peaking at around 114. I'm going to pull up a 52-week chart so you can see what it was at last year. It was at 114, and that's when you saw really, that's the crude right now, but in any case, I'll pull up the DXY. That's when we really saw equities bottoming. And so you had this correlation between when the U.S. dollar is weaker, then you see equities go higher. When the U.S. dollar goes stronger, you see equities go lower, and also commodities, et cetera, especially because commodities are priced in dollars. So if we continue to see a downward trend with the dollar, then we could see some support for equities as well, guys.
Inez, thank you very much. Appreciate it. One of the biggest online shopping events of the year, self-created, Amazon Prime Day, kicks off tomorrow. But could the e-commerce giant be in for a rude awakening, either on its big sales day or soon thereafter? The Federal Trade Commission is expected to file a suit against Amazon in the coming weeks. The regulator filed a complaint recently alleging that Amazon signed customers up for Prime without their consent and also then made it difficult to cancel. This suit's expected to be a big one for the FTC and its current head, Lina Khan. Joining us now with the implications for Amazon is Owen Tedford, Beacon Policy Advisors, LLC, Senior Research Analyst. Owen, thanks for being here. So the allegations that the FTC has made here are similar to those that were made in Europe as well. There, Amazon did settle. How are you expecting this to play out here?
Sure. So I have no expectations that Khan would be interested in settling. She's shown little interest throughout her whole time as FTC chair in reaching these negotiated agreements. She feels that even if they lose the overall court case, there are wins that can be gained. You can see this in comments after things like Meta Within. She felt the agency's argument was validated by the judge, even though they didn't win the case. So she's looking at these through a different prism than many of her predecessors are. I think with Amazon, what's really interesting is the timing of the actions. You mentioned the case related to the difficulty of unsubscribing from Prime. That announcement came the same day that Amazon announced its Prime Day dates. So coincidence? Maybe, maybe not. But I think with the possibility of this case coming at some point in the next few weeks, Amazon's Prime Days coming up Tuesday, Wednesday rather, and then Lina Khan testifying in Congress on Thursday, maybe there's a chance lightning strikes twice here.
Okay, and so there have been a lot of companies that have tried to mount a case against Amazon. What's the possibility that this one actually has success?
I mean, we're looking at a years-long timeline. I think that it's going to be an uphill battle regardless, going after any of these tech giants, just given the resource difference between Amazon and the government that exists these days. So it's going to be a battle that lasts over years. I think there's, of course, Khan's going to put her best foot forward. And I don't think that there's something personal that might be, driving her to file here where maybe others wouldn't. But certainly, it's going to be an uphill battle, I think, for the government to emerge victorious.
Now, we're just showing here, Owen, some of the FTC's tangles with Amazon, and one of them has to do with something that hasn't closed yet. That's the iRobot acquisition here. Is there a relationship between that and the current other investigations we're talking about? Could we see the FTC block the iRobot buy as a result of that, or just block it regardless?
I certainly think there's a possibility that the FTC would file to block it. I don't know that there's necessarily a connection between that and the major case, but Khan has certainly been interested in kind of poking the bear, so to speak, taking these privacy violations related to Ring, related to Alexa, the one recently about Amazon Prime. What was interesting is they didn't block the MGM transaction earlier in the year. And I think part of that might have been that Khan didn't have her Democratic majority at the time. So it was still a 2-2 split at the agency. So, any cases that had to move forward had to get bipartisan support. Now that there's a clear Democratic majority and there's also no Republican FTC commissioners at the moment, she has a little more leeway in pushing the boundaries.
What type of damages are we talking about here? A compensatory, punitive? Is it clear at all what is being sought?
I mean, I think if you ask Khan, her ultimate goal would be to create some sort of division between Amazon's marketplace and its logistics service. I don't know if that's necessarily a realistic outcome. And I think we're probably looking at something where there's more restrictions and more transparency into how companies get the buy box and what more equal treatment of customers selling into the marketplace that use Amazon's logistics services and those that don't.
Owen, whenever we have these regulatory discussions about big tech, my brain goes to the same place, which is that we have talked about all of this stuff for years, right? In a variety of lots of different ways when it comes to regulation of big tech. And nothing huge has materialized. Yes, there have been some fines from the European Commission, for example. But certainly in the U.S., there hasn't been anything that sizable, right, since Microsoft, what was that, now 30, 25 years ago, whatever it was. Do you see anything materializing that's of that magnitude that investors need to consider?
I can't confidently say that the outcome of this case or these major tech cases that are pending could lead to such a transformational outcome. I think there's a fundamental mismatch between what regulators are trying to achieve and the legislative support that they have. So that was something that was tried to remedy last Congress through new laws, but those laws have been stonewalled last session and are running into complete roadblocks in the current session. So I think someone like Lina Khan, who is an advocate for tech reform, is going to continue to try and push the mantle and see where she can maybe take wins. But I think she even will acknowledge that the reality of creating a truly transformational outcome through the judiciary is just unrealistic.
We've already seen kind of more internationally, and of course, take this with context for what the international equation looks like with regard to large companies. You think about an Alibaba that broke up its business into 6 different parts and is now thinking about taking different ones public. All that as kind of fodder for the conversation here as to would we ever in the U.S. see that type of pressure on companies as large as they are right now to break up different entities of their business?
There's certainly pressure on big tech from both sides of the aisle. But I think the pressure to break up these companies is fundamentally a Democratic one. There's some Republican interest in antitrust, but a lot of the GOP criticism of these companies stems from concerns about content and content moderation and the alleged censorship of conservative viewpoints. So I think there is a mismatch there in priorities that will kind of inhibit that pressure from ever getting to be such a chorus point that it's going to lead to these breakups. Additionally, you're not going to get consumers really on board. I know, I use Prime and enjoy it. And I think if there was a risk at losing that service, that might make me reconsider some of my choices in terms of, voting. And I can't imagine I would be the only consumer thinking that way.
All right. Oh, and if you enjoy Prime, then maybe I'll take another look at it. I don't know. It's long known that I am a long-time Amazon or Prime member pushback, but that's neither here nor there. We could discuss that over Threads, perhaps. Owen Tedford, Beacon Policy Advisors, LLC Senior Research Analyst. Thanks so much for taking the time today.
Thank you.
All right, everyone. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
Interest rates are thought to be higher for longer. When you think about that phrase, what is higher and how long is long to you?
I think it's probably right around where we are right now. It's higher than, 40-year lows, but I don't know why they would have to go much higher, especially considering how much the inflation rates have been coming down.
So we'll stay at a 5% interest rate for some amount of time.
Sure.
Welcome back, everyone. We're just moments away from the clock striking 10 a.m. here in New York City on this Monday. This is Yahoo Finance Live. I'm Brad Smith alongside Julie Hyman. We're about 30 minutes into the trading session as well here. And so taking a look at some of the market movers, we're keeping an eye on China's equity markets as the latest economic data from the world's second largest economy sparks concern around deflation risk. Inflation data is also key stateside this week with June's U.S. CPI report this Wednesday.
Shares of FMC Corporation falling today after the agricultural sciences company cut its revenue outlook for the second quarter and full year 2023. The company now expecting second quarter revenue between $1 billion and $1.03 billion. $1.42 billion was the lower end of the prior forecast. The company citing abrupt and unprecedented cuts in channel inventory by customers.
And we're also looking at Advance Auto Parts this morning. The stock dipping after getting a downgrade from Atlantic Equities. The firm cut the stock down to underweight with a price target of $50, citing weak performance indicative of structural changes, saying that the company's current strategy isn't enough to drive acceleration in the second half of the year.
We've got a big week ahead of us. Important data, the start of second quarter earnings season, a lot to consider. Joining us now to cover all of it, Yahoo Finance reporters Josh Schaefer and Alexander Canal. Josh, let's start with you. Give us the calendar here. What's on the docket?
Yeah, we got a more full calendar this week, guys. I'm excited about the calendar this week. Some weeks we come in and we're not fired up about the calendar. We're fired up about this calendar because it's the start of earnings season. You take, right now we're looking at the economic calendar right there. You can see you have the Fed Beige Book on Wednesday, CPI also on Wednesday, and then of course consumer sentiment, the first reading of that University of Michigan consumer sentiment for July expected on Friday. But I'm really fired up for earnings season to start too. We have bank earnings on Friday, and then you also have Delta reporting on Thursday, and Pepsi also expected to report on Thursday. But I think a key theme when you think about this week is really what have the interest rate hikes started to do to the economy, right? And when you think about what have they started to do to the financial system, how are they dealing with those high interest rates? And then how are they impacting inflation and CPI? Allie, I know that's something you've been following closely. Looks like those headline numbers are sort of expected to fall pretty heavily in that report on Wednesday.
Yeah, inflation expected to slow down, but it will still remain significantly above the Federal Reserve's 2% target. That, along with the strong jobs report that we got on Friday, which showed unemployment low, wages high, suggests that there will be more rate hikes to come. So here are the expected CPI numbers according to consensus estimates compiled by Bloomberg. We see headline inflation expected to have risen 3.1% on a year-over-year basis in June. That is a slowdown from May's 4% rise, with monthly inflation expected to tick up to 0.3%. Then if we take a look at core inflation, that strips out the more volatile pricing of food and gas. That's expected to have a yearly rise of 5%. Yet another slowdown compared to May, with monthly core prices hitting 0.3%. According to a new note from Citi, the slowdown is expected to come from two things: the deceleration of shelter pricing, which has long been expected, along with a decline in used car prices. That has remained stubbornly high, but we're expected to see that come down in this print and continue to come down through the back half of 2023 and into 2024. But again, guys, this is not enough to convince the Fed to pull back on those rate hikes. All the analyst notes that I've been reading pretty much expect that on that Fed meeting on July 26th that they will raise rates by another 25 basis points. Markets are pricing this in as well. Data from CME Group has about a 93% chance of that. And there is some expectation that we could see more rate hikes through November, but that's all going to depend on the data. The Fed has consistently said it's data dependent. CPI is a critical part of that data set, so we shall see.
By the way, we said nothing of note. WD-40 reports after the close today.
Hey.
I'll be curious to see how they do. I'm not even kidding.
Good consumer brand.
Good consumer brand. I mean, one of the things I'm going to be watching really closely that kind of brings the earnings and the inflation stories together is last quarter we heard so many companies, Pepsi is one that stands out to me in particular, where the volumes weren't very impressive, but they were managing to get those price increases through. So I think it's going to be really key this quarter to hear if that is still happening.
Well, can you still get the price increases through with inflation coming down, right? At what point does the consumer say, wait, inflation's coming down. I'm reading headlines that headline inflation's coming down. Why am I still paying more?
Well, it's a chicken and egg situation, right? Headline inflation is decelerating because they're not able to raise the prices. And then when you're a consumer and you see the news that inflation is starting to decelerate, then you say, wait, why am I still paying? And then it hopefully starts to.
And then if I'm a company, what does that do to my margins, right? Because am I still paying those inflationary prices and not being able to pass it on to the consumer? That's a big thing some of the analysts
And so
want.
that feeds into the magic word this earnings season, at least from the perspective of Peter Cher, who we had on earlier. Last earnings season, it was all about how many people could say artificial intelligence so many different ways. But how many different ways can companies say resiliency this earnings season? And that's going to be something that, at least from Peter Cher, who gave us that earlier today, could be the type of magical phrase or talking point or word that we hear this earnings season.
We'll see.
Yes, we will. Thank you so much for joining us, Ali Canal and Josh Schaefer here this morning. Let's continue this conversation. Is the Fed sending the U.S. into a recession? That is the question one investor, analyst, and consumer minds right now. According to the SAM rule indicator, a gauge that has correctly predicted 60 previous recessions, we are not anywhere near that territory. Now, the SAM rule looks at unemployment data, and if the 3-month moving average rate rises 0.5% or more relative to the low of the previous 12 months. Now, that indicates a recession. And joining us now on this and the Fed's next move, the creator of the SAM rule herself, Claudia Sahm Consulting, founder and former Federal Reserve Board economist. Great to have you here with us this morning. So, based on your own rules right now, are we set up for a recession?
Right. Well, I'd be clear, the SAM rule is not a predictor of a recession. I mean, you kind of use it as it gets higher and higher. It was put together as an indicator of a recession to send out fiscal relief. So that was why the SAM rule exists. But I'm happy to know other people are using it in a way they think is helpful. But yes, to your question, the SAM rule is under a tenth, right? So, and the trigger is 0.5. So we're in a good place, but that doesn't guarantee that 6 months from now we will be in a good place.
Right, and I know, Claudia, it's Julie here, it's good to see you. I know in particular that some of your research has focused on the job market, on incomes. You've been writing about that as well. And I think one of the interesting questions here, as things slow, what we are going to see happen to incomes among Americans, and then how that is going to feed through to the economy. How are you thinking about that, especially in the wake of Friday's report?
So to me, Friday's report was good news, right? We still have people getting jobs. We have, and the 200,000 is really close to the average we had before the pandemic. So to me, that's a sign of we're getting back into balance, right? There were a lot of things that didn't work during the recovery. Now, one of the things that did work is the labor market, and that was important to people. And what we're experiencing now, we're starting to see things slow. The Fed, to get their we're not going to have a recession idea, and I share a lot of this, is they need things to slow, normalize, and then stop falling. Right? That's never been the case. Like once the SAM rule, this tiny increase in the unemployment rate happens, we are in a spiral that often leads to pretty sizable unemployment rates.
And so, all of this considered, we'd heard about so many different landing scenarios. What type of landing scenario, to the extent that we keep using this analogy out there, which one seems most likely to you?
In terms of a recession or not?
Yes.
Is that what yeah, so I am still right on the edge, but I'm still optimistic that we can do this without a recession. We need some good luck on this, which we have not had very much of, in terms of big disruptions like the pandemic, the war in Ukraine. I mean, you can list them. There are things that make it very hard to navigate. And so I really think we could stay out of a recession. People could keep their jobs. And one thing I've said repeatedly when we get these good jobs numbers is, we still have job openings. Right? There may be some mismatch, but there are job openings. And what a better way to solve a labor shortage with labor, right? Instead of fewer customers. So I also think that's what the Fed is trying to do, but I'd be very honest, we haven't pulled this off before.
Well, and that's what I was going to ask you, Claudia. When you look at the sort of delicacy of where we are right now, is the biggest risk, does it remain the Fed? That's something that we've been hearing from a lot of economists. Do you agree?
So I'm really puzzled by the Fed in general. I mean, as a macroeconomist looking at it, if you told me we had 5 percentage point increase within a year, and you asked me, oh, what's the unemployment rate? I would not have said 3.6, right? Like this is something very unusual in the economy, and how we get ourselves back on track. I mean, this will be a new normal in a sense, but if we can get past this disruption without having another major disruption, it's going to take a while to get inflation down, but we would really be on a solid path towards it.
Well, something else we have to consider when talking about the economy, U.S. President Joe Biden on a mission to convince voters across the U.S. of the validity of his economic plan. Biden touted Friday's jobs report as Bidenomics in action. Can voters really credit Biden's policy action for the economy's resilience? Claudia Sahm is still with us, Sahm Consulting founder and former Federal Reserve Board economist. You have written about Bidenomics as well. And I know that you have been a proponent of this sort of fiscal support that we have seen in the economy really since the beginning of the pandemic, off and on, but mostly on. Do you think that so-called Bidenomics has been a success? And if it is, how do you sort of get the American people to get the memo?
Yeah, first, we haven't written the book yet on what happened the last 3 years. So I think it's premature to give credit or blame. And frankly, there's too often the idea that the president is in charge of the economy. So like they're judged against that, and that the Fed is the only one that can fight inflation, and then we push back on that. So I do think Biden economics, at least as he stated it now, it's also this, we can get to a better place, an even better place than we were before this recovery. And I do think there's some things in the works. A lot of these industrial policy programs will help build resiliency in the economy. That's going to help a lot, but this will be far after he could even, be in office, right? So I think it's a good start. I don't really like the term Bidenomics because I don't think we should attribute too much. But on this little more to your question, they are not going to win voters over on this, right? This is not. It's going to take too many years. It's kind of subtle. Hey, it'd be worse if we didn't do that. So I think he should do the policies. But I know, and I'm not a politician, but I don't think given the divided country and all with inflation and things that have happened, I don't see them giving Biden any credit for this.
What is the timeline that we would actually see effectiveness in some of the policy that has moved forward? From your perspective and an estimation and some of the dollar figures that have been tossed out there by the administration and even those that have been put into action right now?
Right. So, I mean, I don't put a whole lot of weight on the rhetoric from a politician. I mean, they need to do it. And it was interesting in his speech, most of what he pointed to were the infrastructure, the CHIPS Act, the Inflation Reduction Act. He was really pushing like how that will improve growth and just resiliency. And those will not pay off for years, right? Like he's planting the seeds in an important way, but this ain't going to happen by November or whatever time next year he's, trying to push the package forward. I am a little concerned that the rescue plan gets so little weight. It contributed to inflation, but it was nowhere the whole of what we've seen. And it did a lot of good. It did a lot of relief. The child tax credit was in there, but I get it. It also coincided with an increase in inflation. But like I said, more broadly, the people who don't like what he's doing now, they're not going to like what they're, getting started in the next few years.
And Claudia, when you look at what Biden has done on this front, what do you think is the most significant structural change of those measures that we're mentioning here? And what do you think is still the most significant change that should be done that hasn't yet been done by him or by anybody for that matter?
Yeah, so I think the most encouraging was the Inflation Reduction Act. That we have the first green energy or transition energy policy written down, right? This can help buffer. Gas prices will go up again sometime. If we're less dependent on the international market, then it won't be as disruptive as it was. So there really are pieces of that are very exciting. And I think the infrastructure and the CHIPS Act, not to, give them second fiddle. But in terms of what didn't get through were the investments in people. Like really persistent as investments, whether that's the child care or the sick leave. I mean, there's just all these kind of things that the labor market was so tight. Workers could go in, even low wage workers, and be like, I'll come work with you, but you're going to pay me more. Or you're going to give me benefits. And that moment is over, right? Like, because there wasn't institutions to keep it going. So I think that's where politicians need to come together. I mean, if children, I can't think of as that's like the best example of investment we have, and that was like one of the ones that got left on the cutting room floor.
Yeah, seriously. Just lastly, while we have you, as we think about some of the other kind of contenders that are out there trying to knock Biden off the top spot in 24, or at least as we shape up this general election in 2024 that's set to come. Where do both parties need to find some type of uniformity in policy that has been put on thus far, or that has been moved forward, where spending has initiated, where there is a need, at least in this country, both economically, but perhaps infrastructurally as well?
Yeah, we actually had Infrastructure Week. I mean, wow, like they got, and that was a bipartisan getting the infrastructure through. So it's clear there's an understanding of, we don't want our pipes to have, water that hurts people. We want to have Wi-Fi. We want to have, like, the list of things that those more supply investments had, I'm all for. I mean, some are really hard, like industrial policy, to do well. Another thing that I've seen the administration doing that I worry about a little bit is taking one thing that passed and trying to push something else into it that you wanted. So like the CHIPS Act requiring semiconductor companies to have on-site childcare or some kind of childcare. Like, I believe in both of those separate, but it's really, I worry that they're making an impossible task for themselves trying to layer one on the other.
Well, we'll see if there's any chance of them getting some of this done, at least in isolation, even in the next several years. Claudia, it's always a pleasure to talk to you. Thanks for your time this morning. Claudia Sahm Consulting founder and former Federal Reserve Board economist. Thanks.
Thank you.
We've got all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
AI right now, as we sit here, July 2023, hottest thing that we've seen in quite a while, maybe since crypto. Is AI hype real or artificial?
I think it's real. I think there's enough skepticism toward AI and what we've seen so far that I think that it might still be underestimated. I think one of the most interesting things I've heard in terms of sort of assessing the situation with AI right now is that with technologies like ChatGPT, it appears to be passing the Turing test, right? This idea that the AI can create something that is indistinguishable from something that a human might create. And people read the output from something like a ChatGPT and they can't tell the difference between if a human wrote it or if a robot wrote it. So I think that's really exciting. It's scary in many ways, but it's also potentially very exciting.
Are you using ChatGPT to write your newsletter?
I'm using ChatGPT right now.
Let's do a check of the markets now, sponsored by Tasty Trade. We've got all three major averages in the green. Actually, I stand corrected. The Nasdaq just ticking into the red, but really it's a little changed here. The Dow's in the driver's seat today, up about 2/3 of 1%, or about 220 points here. As we've been seeing communication services doing well, at least out of the gate here this morning, although then it's a little bit surprising to see the Nasdaq down. But we got a lot going on this week that investors have to consider. The skyrocketing success of weight loss drugs like Ozempic has completely upended the $75 billion weight loss industry. Companies like Noom and Weight Watchers, originally built around meal tracking and coaching, are now expanding into the weight loss medication race. Even health companies not normally in the diet industry are getting in on the action. Hims & Hers CEO, for example, telling Axios the drugs are, quote, an exciting space for their customers. Joining us now is Nathan Bomey. He is Axios business reporter and co-author of the Axios Closer newsletter. Nathan, thanks for being here. This is so interesting, right? Because at first, we kind of thought of it mainly as a drug company story, the companies making these drugs. But now it's a matter of distribution and how people are changing their whole weight loss philosophy. So what is it meaning to these various weight loss companies?
Yeah, I mean, there's so much opportunity here. This is a lot more than just the pharmaceutical space. We're seeing these companies that have historically built their entire business around personal responsibility and, like you say, meal tracking, calorie counting. Companies like Weight Watchers and Noom are realizing that their entire identity might have to change because of this, because these weight loss drugs are so effective for so many different people. This is upending the entire idea of how you actually lose weight. And so I think that the companies like Weight Watchers and Noom came to a crossroads and had to decide, are they ready to change? And are they willing to embrace this new reality that a medical solution has emerged that could help a lot of their customers?
I mean, how much of this has come about just because the actual intellectual property or the patents have expired at this point, and now there are so many different players that can essentially just come out with their own replica?
Well, I do think that there's some of that going on. Semaglutide, the active ingredient in these drugs, is common to several of these different treatments, and we see some that are actually still in the pipeline too that are said to be even more effective, like Eli Lilly has one on its way. And so, this is something that is here to stay. We see companies that are pursuing pill-based drugs now because the ones that are on the market are actually injections at this point. So the thought goes that this could actually become even more popular because people who are afraid of needles suddenly will have a solution available to them as well. So yeah, I mean, I think that there's always going to be the pharmaceutical industry jockeying over who has control of drugs because of the patents. But I think the destiny here is to see these drugs more and more popular.
I have to admit, I keep waiting for the backlash on this. And maybe one hint of that is an EU government agency that is investigating whether some of these drugs cause suicidal ideation, for example. So you have that as an emerging, perhaps, question about these products. I mean, there's also the idea that once you're on this stuff, it's very difficult to go off of it without just regaining the weight. So I wonder if you've seen any signs of that, this investigation or elsewhere, that could sort of stem the tide, if you will.
Yeah, I mean, it's a really good question. I think with any new emerging pharmaceutical treatment, you always have to look at the other side effects and what are the possibilities that we're missing here. And so I think that the healthcare community has actually been taken by surprise a little bit by how quickly this has swept across the nation, swept across the world, because, I mean, so many people have been looking for help for so long and have not been successful with their own journey to be responsible with their health, because there's a realization that obesity is actually a chronic condition and is not always something that you can control with your personal responsibility. On the other hand, we know that there's some abuse of these drugs going on, and that's another issue, is people who are taking these drugs who actually don't necessarily medically need them. So there's that issue to sort through as well.
What responsibility do social media companies have in this as well? And the whole age of the influencer or the fitfluencers out there and the fashionistas, the fashion models that you see, of course, across your timeline. I don't know if it's your timeline, Nathan, but for sure in my own, I'm sitting here looking at all of them like, all right, I need to do a little bit more. And it's created this permeation of thought across TikTok and Instagram and all these other visual mediums to say, okay, to achieve that, I need to do something drastic that ultimately has some more addictive qualities to it at the end of the day, too. So what role have social media companies acknowledged within this, if any?
I haven't seen any, and I think that a lot of this does stem from Hollywood. Hollywood is, I think it's no secret that a lot of celebrities are taking these drugs, and whether they really need them or not, I can't say, but I think it's an issue, and I think we live in a culture that is obsessed with being thin, and the question is there a line that to draw between the need to be thin versus the desire to be thin? And I think we're going to, as a country, as a culture, going to have to grapple with that question.
Yeah, indeed. Well, switching gears while we have you here, Biden's betting big on electric vehicles, but it could come at a major political cost. The president has yet to secure a key endorsement from the UAW, the United Auto Workers Union, as you know them in your hood, who has said that they're withholding support until their concerns about pay and job security in the electric vehicle transition are met. We're joined again by Nathan Bomey, who is the Axios business reporter and co-author of the Axios Closer newsletter. All right, so kind of bring us up to speed on this a little bit, Nathan. Where do these talks stand?
Well, the UAW is making a lot of noise about a possible strike coming up in a couple of months because their contract is up with Stellantis, Ford, and General Motors. And so they are really saying they're not willing to endorse President Biden at this stage because they are upset with the way the president is handling electric vehicle incentives. So I think that this is a dispute that is going to go on for a while here because the UAW represents workers who primarily make gas-powered vehicles. I think that the concern among the unions is that that the EVs could come along and displace the workers who are making gas-powered vehicles. And unfortunately, EVs don't require as many people to manufacture them as gas-powered vehicles because they have fewer parts. So I think the unions want to see that the administration and the country is committed to ensuring that this transition happens while protecting the union jobs.
I mean, at the same time, we got a little while till the election, A, and B, who else are they going to endorse? I mean, is there any real suspense here?
Not a lot of suspense in the sense that they're certainly not going to endorse Donald Trump, for example. I mean, the UAW is not going to go that far. However, it's important to note that in both 2016 and 2020, about 1/3 of UAW workers actually did vote for President Trump. So this is not the extremely liberal union of the past. And I think you've seen that in some of their rhetoric over the years. During the Trump administration, for example, the UAW was fairly aligned with the Trump administration on getting rid of the North American Free Trade Agreement, NAFTA. So they're not necessarily purely Democratic supporters. However, they are still a fairly progressive organization at the top. And the question sometimes is the leadership of the UAW in line with the members?
So how will this affect reaching some of the electric vehicle goals that have been set forth?
Well, I think it's the EV transition is a bit of an unstoppable train at this point, if only because the automakers see that investors want EVs. They do not want gas vehicles at this point. Anyone who invests in EVs is being rewarded in the markets. And so I think the automakers are going to continue to make these investments, even though the public has been a little bit slow to embrace them. So, I mean, I think we're going to get there, but the transition could be a little bit rocky.
I personally want a jetpack, but I suppose I'll settle for an EV. Nathan Bomey, Axios business reporter, co-author of the Axios Closer newsletter. Great to have you here with us today, Nathan.
Thank you so much.
Absolutely. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
Sitting in a lot of client meetings, answering a lot of client emails, what's the number one question that those folks are asking you right now?
It is all about how is AI going to be integrated into everyday businesses, and what is the impact on that for the labor market?
U.S. Secretary of Treasury Janet Yellen concluded talks in China this weekend, meeting with the newly appointed Communist Party chief of China's central bank. She claimed that while the talks were substantive and productive, repairing the tense relationship will not be solved overnight. For years now, the relationship between the U.S. and China has been nothing less than contentious, with some going as far as to claim that it's the new Cold War. With continued conflicts over the China-Taiwan Strait, growing economic concerns, and strong rhetoric denouncing each other's leaders, the tension doesn't appear to be easing anytime soon. Let's bring in Yale University senior fellow Stephen Roach. He penned an opinion piece for Project Syndicate, The Wrong Way to Manage U.S.-China Relations. So first, I guess, what's the right way to go about it?
Well, I think we've seen now two examples of what both sides are trying to go back to, which is the conversations without actionable consequences. And, it's starting to seem to me like this is just a return to the old approach we had, endless rounds of diplomatic discussions from time to time, punctuated by these big summits they called strategic and economic dialogues. But it's an approach that failed to prevent the conflict that you just alluded to, the trade war that's morphed into a tech war and now the early stages of a new Cold War. And, I think this is a personalized approach that reflects the chemistry between leaders, but ultimately one that is also constrained by domestic political considerations in both countries. And it failed to prevent this seismic conflict that we're now in the grips of. And I don't think it's going to succeed going forward.
It does seem that personalized diplomacy, at least for the moment, seems to have avoided getting worse, right? The fact that Yellen went there, and it seemed to me that that was the goal for now, right? That things would not deteriorate further. Do you think, though, that in this current framework of this, what you called in your piece, personalized diplomacy, that there is any possibility for further progress, not just lack of backsliding?
Well, considering where we've been going, lack of backsliding is clearly an uptick. But, the goal was set largely, and it was a modest goal at best, by Presidents Biden and Xi when they met in Bali last November, when they both agreed to put a floor on the deterioration in the relationship. And so Blinken finally goes after delaying his trip because of the great balloon fiasco by 4 months, followed by Janet Yellen, and most likely, very shortly, by John Kerry. And they're putting in a floor, and I think that's good. I agree with your point. It's definitely preferable to the no-floor approach where we have been headed. But is the floor strong enough to withstand further developments as they occur? The U.S. has been telegraphing, for example, that it's going to put significant restrictions on outbound foreign direct investment into Chinese technology. And China has also very recently put restrictions on the availability of very important minerals that go into the production of semiconductors. So there's still a series of repeated blows here. And, it's dubious to me as to whether or not the floor approach is the right way to move this relationship to a more constructive position.
So with that considered, what is the best good faith concession that each of these economies, each of these countries could make that may start to strengthen or re-globalize the relationships?
Well, I think one thing that could certainly be done that would be very important is to restart military to military discussions. And we've had near misses, serious near misses between, ships in the south, in the Taiwan Strait, and airplanes in the South China Sea. And yet we have two defense ministers who will not speak to one another, and the Chinese resist this because their current defense minister is now on the personal sanctions list of the United States for actions that he purportedly took in an earlier capacity before he became defense minister. If we want to make a serious gesture to restart the military discussions, take the guy off the sanctions list and let's get on with serious discussions before we have a major accident. We can do that.
So how do we fix all of this, I guess, is a short question with probably a very long answer.
Well, I'll try to be short, but I do have a long answer. I wrote in my recent book, Accidental Conflict, about a new approach I have to relationship management framed around what I call establishing a U.S. China Secretariat, which is a full-time organization located in a neutral jurisdiction, staffed by equal complements of Chinese and American professionals who are engaged in troubleshooting, collaborative joint policy approaches, and participate in a dispute resolution mechanism. It operates full-time. It's not one that is adversely influenced by the personal egos of thin-skinned leaders who are always looking to establish better face in the position that they achieve with their adversaries. And I have continued to stress this is a far more depersonalized, institutionalized way of managing the process of engagement than going back to the old way that failed.
Yeah, and of course here too, we're subject to things like elections, which also affects that face saving in quite a different way as well. Stephen, it's always good to get your perspective on these matters. Yale University Senior Fellow Stephen Roach, thank you.
Thank you.
Much more markets action ahead. Stay tuned, you're watching Yahoo Finance.
The number one question that you are asking yourself right now about markets, maybe one that you don't talk about with clients, one that, when you're sitting there at night, what is the thing you're worried about, or the question you really don't feel like you have an answer to?
It's the question that I do ask constantly. I think it's the one that's not talked about, which is when are we going to go back to looking at cash flow, cash flow, cash flow? It's been a while. It's still multiples of lots of metrics that get adjusted frequently or they're top line focused. When's the market going to go back to be cash flow focused?
When will we stop doing non-GAAP, whatever?
Fundamentals or that kind of thing.
Sure.
Yeah, exactly.
Sweet Jesus.
Friday's jobs report showed hiring is slowing, but with wage growth remaining strong, the Fed still faces pressure to raise rates at the next meeting. Jennifer Schonberger spoke with Acting Secretary of Labor Julie Su about the report on Friday.
So this is a good jobs report. This jobs report represents steady and stable growth, which is what we want in the economy, right? That is part of President Biden's economic plan, is to make sure that there is steady growth. He's helped shepherd a recovery from the pandemic-induced recession, and now we see continued growth. And combine that with the 3.6% unemployment rate, which, for the last 17 months straight, unemployment has been less than 4%. It hasn't been like that since the 1960s. And so those combined figures really demonstrate that President Biden's economic policies are working. And what we do want is that steady, stable growth as represented by today's report.
To your point, as far as strength is concerned, we saw wage growth of 4.4%, still very strong, still seeing a lot of demand for workers in this economy, especially in the services sector. How much of that strength do you think is being driven by lingering effects from the pandemic? Lower immigration, early retirements. How long do you think that's going to persist?
That's right. So we are in a tight labor market, right? In a tight labor market, workers have more power. They have more choice. They have the ability to move from jobs to better jobs. And we've certainly seen that since the president came into office. But we've also seen a return to pre-pandemic labor force participation rates, especially in that prime age workforce from 25 to 54. And that is also a sign of a strong economy, of people having confidence, of people coming into labor market looking for jobs and getting jobs. And those are all good things. And we certainly see that overall. But for women, we see that women have now marked the third straight month of the highest labor force participation rate for that age group in 75 years. These are all signs of strength. It's a sign of Bidenomics having the effect that we had, and all these things really, frankly, defy expectations.
How much longer do you think that workers are going to keep the upper hand here, and we're going to see these trends persist before the Fed finally starts to cool the job market?
Right, so I don't want to speak to Fed policy, right? But certainly what we are really committed to here at the Department of Labor and across the Biden-Harris administration is making sure that additional investments are creating good jobs in every community and also bringing industry to the U.S., right? We're focused on manufacturing. We've had almost 800,000 manufacturing jobs created since the president came into office, and we're just getting started. We have infrastructure investments. We have semiconductor and chips. So all of these things are about delivering things for the American people and also creating good jobs in every community. And again, today's report is a sign that that kind of stable growth is not only possible, but it is actually happening under President Biden.
You mentioned women. Women's participation in the labor force at a record high, above 77%. Yet women's wages, if you look at women versus men, they're only earning 83 cents on the dollar versus men. And we're talking about women in full-time jobs here. Why is that gap still persisting, and what can be done to really close that?
Yeah, thank you for mentioning that, Jennifer, because we talk about women helping to power this recovery, right? And women, as always, are doing our part. But there remain systemic issues that affect women. Obviously, some of it is care and the cost of care, something the president's talked about a lot. There's also occupational segregation that leads to the gender wage gap. And we see this moment, and the president has been crystal clear about his commitment to equity, leave no one behind, make sure every community comes along in the growth that we have. And so part of it is the jobs that we're creating. We want to make sure that women have access to those jobs, that they have the training that they need to participate in manufacturing, in construction, right, in all of the growth that's happening. And so those are priorities that we have. When the president says we need to finish the job, we have more work to do, that is part of what he means.
Is the president, is the administration looking to put in place any further policies to maybe help with childcare or help women women who want to participate in the workforce or participate in jobs that would allow them to aspire for higher paying positions?
Absolutely. So the president has called for policies, right, like paid leave. He's indicated the importance of care work and making care both affordable and care jobs good jobs, because most of those jobs are also done by women. One of the things we're focused on at the Department of Labor is creating workforce development programs where we bring in workers and employers to focus on how we create opportunities for women. And what we've seen is when we do that, women step up, right? Women do these jobs, and it helps to close that gap.
Switching gears, Secretary, UPS drivers are potentially on the verge of a strike. Teamsters, the labor union that represents more than half of UPS workers, some 340,000 workers, has come to an impasse with the company. Are you prepared to intervene? Are you talking with parties at all? And if there were to be a strike, what kind of impact would we see on the job market and the economy, just given how integral UPS is to supply chains and companies that are relying on that company to get customers their products and packages?
Right. That's such a good point about, the importance of the work that UPS workers have done and the importance of what that company, throughout the pandemic, right? There was increased demand for package delivery, and UPS workers stepped up to do that. I believe, as the president believes, that the collective bargaining process works, that parties coming together at the table and bargaining for wages and working conditions and benefits and the like, that is a process that we should respect. That's a process that has historically delivered not only gains for the people at the table, but to create the middle class, right? Unions made the middle class. That's something the president says all the time. And so I have faith that the parties are going to find a path and continue to try to work things out, and that there are win-win solutions, as we found when I went to the ports to help.
But you're standing back at this point. You're not intervening.
Right. We believe in the collective bargaining process, and we believe that the parties need to be given room to do what they know how to do best.
And before I let you go, Secretary, sticking with the union trend, the UAW, their collective bargaining agreement is set to expire with the Detroit 3 automakers in mid-September. President Biden has appointed a advisor, Gene Sperling. I know he's working very closely with you. How are talks going? Are you prepared to intervene to stop any striking if it were to occur?
So I am working very closely with the White House. This White House has been this administration has been very collaborative around a whole host of issues. I think that's a premature question, right? I think the broader issue, which is consistent with Jobs Day, is that jobs are growing, workers have come back to the labor market, and bargaining is taking place because in a tight labor market, workers have more power, and that's all a good thing, because that's how we create an economy from the bottom up and the middle out, right? That's how we make sure that every job is a good job. That's how we make sure that we honor what workers have done and their power in the workplace. I think those are all part of the Bidenomics vision of what makes a good, strong economy.
Secretary Sue, thank you so much for your insight. It was great to have you on the program.
Thank you so much.
Speak with you again soon.
And that was our own Jennifer Schonberger speaking with Acting Secretary of Labor, Julie Su. We've got all your markets action straight ahead. We are about 80 minutes into trade here on the day, and you're watching Yahoo Finance.
Interest rates right now are thought to be higher for longer.
Yeah.
When you hear that phrase, what is higher and what is longer in your view?
Well, I think Jay Powell's told us what higher and longer is going to be. I think it's another 2 rate hikes from here. I think it's going to be consistent at that level through the first half of next year. And then I think we see, maybe high 4%, possibly still 5% through the end of 2024.
So real rates certainly still in positive territory.
Absolutely, yeah.
Meta's Threads is a major threat to Elon Musk, and the social media app that's aimed at rivaling Musk's Twitter has signed up more than 100 million users in less than 5 days of its launch, according to data platform Quiver Quantitative. If Threads can continue to attract more users, it could put Twitter on its heels. Yahoo Finance tech editor Dan Halley has more on this story. Dan, we discussed it when it first launched, and now 100 million signups, according to this data. So what's going right?
Yeah, Brad, Mark Zuckerberg actually even came out and said that the 100 million number is accurate, saying that basically they haven't even done, proper promotion for this yet, that saying that this is all organic growth, and that, that's the kind of power that this platform seems to have, or momentum that it seems to have. And, just between this and Twitter, this could put Twitter, on its heels, not necessarily out of business, but leave it as kind of, as one expert told me, out of the Mount Rushmore of social media by doing a few things that it seems to be doing right now. The main thing is keeping people engaged. That's something that a website like this needs to survive and thrive. That's really the big deal about Twitter, is that its user base is at least the biggest names are highly engaged. And so that's what they need to kind of replicate on Threads. By doing that, they'll need some big name celebrities. They obviously did that prior to launch. You had the likes of Gordon Ramsay and whatnot already set up with accounts. And, they need to ensure now that thought leaders, experts in different fields, journalists, those folks are part of this now, so that they're constantly using it. Those are really the people that constantly are on Twitter and keep the Twitter conversation going. Most people, anybody that I talk to that uses Twitter basically is just there kind of scrolling through it, not necessarily writing. So that's the engaged few that really help that motor run. And so bringing that over to Threads is going to be incredibly important. A part of that is also involving things like third-party apps, the ability to get desktop apps. You have TweetDeck, one of the more popular apps for Twitter, and that allows you to look at multiple streams of content at once. Experts, at least the folks who are the power users on Twitter, would need that or something similar on Threads to be able to manage multiple accounts or view multiple streams, get the latest news, things along those lines. And then, finally, really, they just need to let Twitter continue to do what it's doing on its own, which is, allowing more extremist views, becoming kind of, continuing to be dangerous for some advertisers, who don't necessarily want their content to appear alongside problematic posts from other folks. So, that's just something that Twitter needs to keep doing. They put on that limit for how many posts people can see. They've introduced charging for the check marks. That's something that, maybe we'll see that on Threads. You can already do that on Instagram. But I really do think that, those are the things that Threads needs to do to kind of just beat out Twitter. It's 100 million downloads. Don't necessarily know who's going to stick around.
Right.
There's 300 million plus on Twitter, but it's looking more and more like Threads is a real challenger.
The first one, it feels like, doesn't it? Because I've downloaded some of those other challengers and I haven't stuck around. Dan Halley, we'll see what happens. Thanks so much. Appreciate it. Well, Rochelle Akuvos got you covered for the next hour of trading. We'll be back tomorrow.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching so far this morning. Could a soft inflation reading move the dial on Fed policy? We'll discuss why Jay Powell and co. may not be out of the woods quite yet. Plus, Cava is emerging from its quiet period to mostly positive news from analysts, raking in 6 buy ratings this morning. We'll speak with one of those analysts coming up this hour. And roadblocks ahead at OpenAI as Sarah Silverman becomes the latest to file a lawsuit against the company. We'll break down where it goes from here. But first, let's take a look at the markets right now, 90 minutes into the trading day. Looking at a mixed picture here, we're seeing the Dow here up about 124 points, or just about a third of a percent there. The S&P 500 there, also just ever so slightly in positive territory there, up just about a point there. We're seeing industrials really pushing up the most there for the S&P. Tech-heavy Nasdaq, they're under some pressure. FANG stocks really being weighed on, apart from Meta. We see that's under pressure. They're down about 7 points. Let's also check in on the action of the Treasury market as well. A bit of a flight to safety here for these shorter term yields, as we can see. That's down about 0.8%. The 10-year also down about 0.2%. And the 30-year up ever so slightly. That's up about 0.5%. We're seeing, a lot of big inflation prints coming out this week. CPI on Wednesday, PPI on Thursday. And also having big banks kicking off the next earnings season. Well, what can we expect from earnings in the second quarter? Well, let's take a look. FactSet says earnings growth for the S&P 500 companies projected to fall 7.2% in Q2. That's according to Goldman Sachs analysts. The bar for companies is low, and they're expected to clear it. Meanwhile, Evercore ISI analyst Julian Emmanuel says Nvidia set the bar way too high with its huge Q2 outlook. Here to break it down for us is Yahoo Finance reporter Inez Ferre. Hey, Inez.
Hey, Rochelle. Yeah, and let's start out with Julian Emmanuel from Evercore ISI and his comments in a note to investors over the weekend, as you were just mentioning, that the bar being set very high, and that's because of Nvidia's blockbuster results earlier this year back in May, and where Nvidia, just to give you a refresher, basically raised its revenue guidance for the second quarter of this year, saying that it will meet about $11 billion in revenue, and that was versus what the street was expecting, $7.2 billion. So a massive beat, a massive increase when it comes to revenue, and that is because of AI, of course, and that AI craze that investors have had as well. Now, be in contrast with Goldman Sachs is saying now the bar is set too low, talking about a consensus of what the street's expecting, and the consensus being of an expectation of a 9% year-over-year decline in S&P 500 earnings per share, and that's driven by flat sales and margin compression. And something interesting that the note also from Goldman analyst talks about is what to watch for. The key areas that investors will be watching for is maintaining margins, trying to push sales for profits, the impact of bank stresses and credit lending, the potential uses of AI, and also the health of the consumer. But bringing it back to this contrast between what Evercore ISI is saying and what Goldman analysts are saying, basically, look, Brian Sozzi, the executive editor of Yahoo Finance, wrote a note this morning. You can check it out on yahoofinance.com. And it's basically saying, look, not all these companies are going to be Nvidia's. In fact, very few are going to be like Nvidia, which is riding that AI craze. He went over to a Home Depot earlier during the weekend, says Home Depot is not selling AI chips. There are many other consumer-facing companies that are also not selling AI chips, tons of companies that are not in the AI space per se. So you can't expect all of these to be like and Nvidia. And again, a lot will come back to the health of the consumer, how much the consumer is willing to spend, tapping into those reserve savings, and also, of course, as student loans are right around the corner as well, the impact that is going to have on spending as well.
Indeed, and as you mentioned, a lot of those bank stresses now expected to show up in these second quarter earnings. We'll be keeping an eye on all of that. A big thank you there to our very own Inez Ferre. Thanks so much.
Thank you.
Well, taking a look at June's non-farm payroll report, it missed Wall Street's expectations for the first time in 15 months. But many economists say it isn't a strong enough sign to indicate softening in the labor market. Our Josh Schaefer is here with a breakdown on why Friday's jobs report likely didn't change the thinking of the Federal Reserve. What's your take, Josh?
Yeah, Rochelle, so you saw that non-farm payroll number miss for the first time in 15 months. coming in below Wall Street estimates for the first time in 15 months. But when you take a look at the Fed fund futures and what we see investors trading in that market, we didn't see much movement. So when you take a look at that CME chart from the Fed fund futures, you can see here still about a 93% chance of a rate hike come July. That number was pretty much right around 93% coming into the report on Friday. So I want to take a look at some of the key charts from that report and really why we're seeing that. When we go to the overall non-farm payroll employment number, you see 209,000 jobs still added. Now again, below Wall Street estimates, which we always talk about, but 209,000 jobs added is no small number. A lot of economists are looking for that number to come below 200,000 before we see sustained slowing down in the economy, and also a more consistent number. Remember, we had over 300,000 jobs added in May, so it hasn't been very consistent yet. That's one key thing to highlight with payrolls. When you take a look at the unemployment rate, that's still historically low as well, sitting down here at 3.6%. You can see how much lower that is than what we saw over the past decade. That is something that Chair Powell has highlighted multiple times and economists keep harping on because that actually came down from 3.7% down to 3.6%. And then when you take a look at wage growth, a key thing to think about when you're talking about inflation is how much money are people making? Well, people are still making more money. You see wage growth increased 4.4% last month. Again, historically higher than what we saw over the last decade. And another number economists keep highlighting when we talk about can people continue to fight through sticky inflation? Well, if they're making more money, they probably can. And that means companies can keep prices higher and inflation overall would remain higher. Now, another thing I wanted to take a look at that is becoming more of the discussion, Rochelle, is the CME futures when we take a look at November. So right here you can see this would be 50 basis points up from where we are now, and this would be 75 basis points up from where we are now. That's together combined about a 40% chance by the time we get to the end of November, the Fed has raised their benchmark interest rate by about 50 basis points or maybe even 75 basis points. If we go back a month ago, before all this strong economic data we've been talking about for the last month, there was only about a 10% chance of people pricing in a 50 basis point move by November. So we've seen a lot of movements actually not in the July numbers. That interest rate hike is largely priced in. Where we're seeing movement now is come September, come November, and people thinking instead of 25 more bits for the Fed to go, it might be 50, which certainly changes things a little bit when we think about the market and we think about what it means overall.
Indeed, the Fed keeps saying higher for longer. It looks like the markets are starting to believe it. Our very own Josh Schaefer there. Thank you so much. All right, well, I'm watching shares of Mumbai-based retail to refining conglomerate Reliance Industries Limited. Shares popping today on news that the company will move forward with its plan to list its financial services business. Now, the company's retail unit will buy back shares trading in the grey market and will give them to employees as stock options. Now, this comes as the conglomerate is also considering listing the holding company of Reliance Retail Limited. The current rally is allowing Reliance to catch up with Indian equities, which have surged year to date as foreign investors pile into the emerging market. All right, well, all your markets action still ahead. Stay tuned. You're watching Yahoo Finance.
All right, the number one question that you're asking yourself right now about the markets.
Is this the top? Every single time I have to wonder if this is the top. And it's a question that everyone's asking, and I think the short answer is probably no. I think enough people are still worried that stock prices have gotten ahead of themselves. They see valuations that are a little bit elevated above historical averages. So I think as long as there are those kinds of concerns out there, that it's probably not.
We were asking this question in 2014, so I guess 2,000 S&P points later, it doesn't really matter.
No, it does not.
Okay.
Let's do a market check. Let's do a check of markets sponsored by Tasty Trade here. Still looking at a mixed picture, although now the S&P has joined the Nasdaq in negative territory. The Dow there still up there about 100 points, slowing from the morning's high though. But the S&P 500, as you can see, they're still down slightly, and the tech-heavy Nasdaq, they're also down just about 20 points as well. Well, passengers are buckled in and ready for takeoff. Despite flight cancellations, crew shortages, and rising ticket prices, airlines have seen a strong recovery in leisure demand so far this year. Now, according to a new survey by Bankrate, nearly 1/3 of Americans have already traveled for leisure in 2023, while 46% plan to do so before the end of the year. For more on the travel industry, we're joined by Ted Rossman, Bankrate Senior Industry Analyst. Good to see you here. So, a lot of us were wondering, after what we saw with spring break, how prepared airlines were going to be for this sort of 4th of July travel and going into the summer travel. But what are we looking at here? A lot of delays and cancellations so far.
Yeah, as expected, it's been a pretty bumpy summer for air travelers. I'm really surprised how robust demand is. In fact, the TSA has already screened 11% more passengers this summer than last. So that's comparing the Friday of Memorial Day weekend through yesterday. And this airline industry is still having trouble keeping up. They're not all the way back to pre-COVID staffing levels. There are still equipment shortages, air traffic controller shortages. And you throw in this robust demand, and then any sort of computer glitch or weather problem. We've had a lot of thunderstorms marching across the country. It just kind of cascades from there. So people want to travel, but they're having to put up with high prices and a lot of delays, unfortunately.
And it's interesting, as you mentioned, this demand issue. 82% of the people surveyed still worried about travel problems this year. You've got, the cost of accommodation on top of everything else, inflation. But why do you think we're not seeing this breaking point in demand then?
I'm really surprised, to be honest. I thought last year was the year that everybody got the so-called revenge travel out of their system, all this pent-up demand that stacked up during the pandemic. Domestic travel was very strong last summer. One thing that's new about this year is international travel is really all the way back. And last year, we still had a lot of lingering COVID restrictions abroad. Now that those have come down, people are taking the long-awaited bucket list trip to South Africa, let's say, or Europe or Asia or other destinations around the globe. So that's one thing that's unique. But I think people are also showing that they're willing to prioritize experiences. So even as they cut back on spending on physical goods, people are putting things like travel and dining at the top of the list. So this pent-up demand has more room to run than I would have predicted.
And there's definitely a generational difference in, the big spenders here, who's spending it and where they're spending. Break some of that down for us.
Young adults are really driving this trend, and I think that's part of a broader shift. We've known for years now that millennials and Gen Zers, they really love experiences. I even harken back to 2016 when the Chase Sapphire Reserve credit card came out. That really changed the game for millennials. Prior to that, people had said, I don't know, maybe millennials don't want credit cards. They definitely did, and they want cards that lean into experiences. Travel, dining, music festivals, these are the kind of things that young adults are willing to splurge on. And we definitely see it with summer travel this year. Young adults and also higher earners are driving this trend. So I think really that sweet spot is maybe the affluent young professional, somebody in their 20s, 30s, maybe doesn't have kids yet. I think weddings are part of this too. We've done some research into weddings and bachelor and bachelorette parties, a lot of destination events going on there. That too feeds into this experience trend.
And it's funny because when you're looking at people, you know, flexing on the gram, you're like, how are they affording all these holidays? But then we're seeing people dipping into their savings, taking on credit card debt. What should we be aware of then in terms of what might be the breaking point when it comes to travel spending?
I do worry about credit card debt just because the average interest rate there is a record high. It's about 20.5%. That's taking a big bite. I would like to suggest people getting credit cards working for them. So you pay in full, you avoid the interest rate. That's when you can really play the game and you get free trips, you get cash back. A lot of credit cards come with valuable travel insurance perks that is especially useful with all these delays and cancellations we're talking about. So that's really a huge fork in the road. I think roughly half of credit card holders pay in full every month, and they're winning with cards. The other half, they're paying high interest rates. So you have to know yourself and figure out this calculation.
So then, Ted, your top 3 tips for really getting the most bang for your buck this summer travel season.
Use your rewards, points, and miles. These are real stores of value, so that's really important. They tend to lose value over time, so definitely use those rewards, points, and miles. Be flexible. That's another important tip. The more flexible you can be with your dates and your destinations, the better, because it's hard to find a deal nowadays. So maybe let the deal dictate the destination and the timing, rather than the other way around. And then finally, I would say, just be patient. I mean, unfortunately, we are going to experience more delays and cancellations. Some credit cards can help you out with travel insurance perks. Other times, maybe you just play that role of the squeaky wheel gets the grease. If you have trouble with a flight, tweet the airline, contact them on Facebook, call them on the phone, maybe consider calling an international customer service number. Sometimes those have shorter waits and can get you to the front of the line.
You're giving away some of my tips here. That's what I do. I always wait until the European office is open and I call that way because, there's nobody else awake over here to take care of it. So good stuff there. Thank you so much. Always good to have you, Ted Rossman, Bankrate Senior Industry Analyst. Thank you so much. Taking a look at shares of Cava jumping this morning after Jefferies and Piper Sandler were among the latest investment banks to initiate coverage on the quick service chain. Jefferies slapping Cava with a buy rating and Piper Sandler labeling the stock as overweight. It's safe to say Wall Street is bullish on the company for now, so is it a good time to buy? For more, we're joined by Stifel analyst Chris O'Cole. Now, Chris, you initiated coverage on Cava with a buy rating and a price target of $48. Why do you find the stock so attractive?
So I think Cava really checks all the boxes for a compelling restaurant growth stock. You've got new units that are opening with excellent returns, 35% cash-on-cash returns. You have a long runway for growth, and the pace of development that they're targeting, about 15% expansion annually, is a very reasonable rate and has actually been proven by other fast casual concepts like Chipotle. So I think the company is well positioned to continue to grow for the foreseeable future, which is why we recommend it.
And so how does the path to Chipotle level versus, say, Sweetgreen, what is going to be the determining factor for Cava?
So in our mind, we went back and looked at the path that Chipotle took when it was a comparable size to Cava. And what we found was that it took about 7 years for Chipotle to grow from where Cava is today, which is around 300 units, to about 1,000 units. Cava believes that they're planning to do that by 2032, so roughly 10 years. So we feel like their pace of growth is very reasonable. We also like the fact that Cava has broad appeal, like Chipotle. These are walk-the-line kind of service models, so consumers come in, walk the line, ask for ingredients to be put into their bowls, or they're on their pitas or salad. And so we feel like the service model is very similar to what you would find at most fast casual restaurants that have high throughput, like Chipotle. And we also think the ingredients, they're fresh, ingredients or sustainable ingredients. Cava, with eating at Cava, you can really achieve any kind of dietary preference you might have. You can indulge, you can eat gluten-free, you can maintain a certain caloric intake. So there's a lot of broad appeal to the Cava concept.
And we know that as with most IPOs, there can be a little bit of a roller coaster as a stock is finding its feet. So if you're an investor looking at this and you're wondering, is this the best time to enter into this, or would there be other bumps in the road and better opportunities down the road to perhaps then buy the stock?
Well, there's always challenges that restaurant companies incur over their life cycle. We think Cava is well positioned right here to execute against the growth, and we also see the potential for upside given the operating momentum they had in the business over the past 6 months. And so we really like the stock here. We'd recommend buying it here. And we would definitely take advantage of pullbacks because we think the company is well positioned to grow across the country. And with only 300 units today and 1,000 in 10 years, I mean, that's a healthy rate of growth that you're going to find a hard time finding in any other kind of consumer brand.
And as we know, consumers have been relatively resilient, trying to stick with some of their favorite brands, but sometimes downsizing or perhaps not going as often or perhaps not getting as much when they go into some of these restaurants. How do you see Cava stacking up against some of the other perhaps value plays?
So we actually think Cava offers a very compelling value. I mean, the quality of the food is incredibly high. We think the ticket is around $13.50 per person, which is very comparable to what you would find at most of these fast casual concepts. And the service is very fast. So you get very fast service. You also have multiple channels you can order Cava on. You can get Cava in the restaurants. You can order over the app. You can have it delivered. You can pick it up. I mean, there's multiple channels that you can order Cava on. So we actually think it's well positioned in a difficult consumer environment because of its strong value proposition.
We'll certainly continue to watch Cava's performance. Thank you so much, Chris O'Cull, Stifel analyst. Thank you for joining us on Yahoo Finance. All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
All right, the number one question that your readers are asking you right now as we sit here, July 2023.
It's the same question.
All right, we're good.
What would you do if you suddenly made millions of dollars overnight? Well, sometimes certain lucky people find themselves in that exact position, winning the lottery. Now, unfortunately, last week didn't see any winners as the Mega Millions jackpot of an estimated $427 million US dollars and the Powerball jackpot of an estimated $590 million US dollars were not drawn. Now, that's a combined amount of $1 billion US dollars. So again, what would you do? Well, Emily Irwin, Wells Fargo's Wealth and Investment Managing Director, joining us now for some advice and planning, joins us to discuss that exact question. So first of all, first thing you do, you see that your numbers have come up in this situation with the lottery. What is the first thing you should do?
Well, the first thing you should do is celebrate. Do a little bit of a happy dance, but do it without posting it on social media for sure. And once you share it with your trusted loved ones, you want to put together a team. So the first thing to think about is who are your trusted advisors going to be as you navigate your new world. And so think about an attorney, a CPA, an investment advisor, potentially even a charitable advisor or philanthropic advisor as well, because these are the individuals that are going to provide you both the technical advice as well as provide you education so you can make informed decisions.
Now, a lot of times, obviously, whatever financial habits you had before you come into sudden wealth, they're going to continue because obviously this is something that's happened overnight. What are some of the biggest do's and don'ts when it comes to this and how people should be thinking about sudden wealth?
You know, thinking about this major change that's happening in your life, you want to think about where you are financially first. And so work with your team to define what are your goals. What do you want this wealth to do for you? Is it going to be something that's going to be extinguishing debt on your balance sheet? Is it going to be legacy assets for your family? Is it going to be community impact? And then work towards making incremental decisions and build out a plan in order to be able to understand how can you accomplish those goals. What you don't want to do, a major don't, is make any major drastic changes in the first few days and months following your big win, because you really don't know how it's going to affect you yet.
It's true, because a lot of people are like, oh, well, I'll quit, I'll do this, I'll do that. But this is a long process it can take for some of these lotteries to really hand all of this out. So in terms of, I know you said you should start by, you can start by telling some of your closest family members. Is that always a good idea? Like, how much of it should you keep to yourself, especially if you're in a state that doesn't allow you to be anonymous?
You know, I think when you think about your trusted family, it's maybe your partner or spouse, potentially adult children, depending on where they are in their financial lives. But the closer, the better in your circle of trust, because you want to be able to control the decisions with respect to your wealth. You don't want to have to start making reactive decisions to requests and asks or feel uncomfortable amongst your friends and neighbors and within your community before you're ready to do so. That's where that team and the goal setting is really important, because you want to be able to take control over the actions as opposed to being more reactive in nature.
And if you're choosing between the lump sum or the installments that you get instead, does it make a difference like where the economy is in terms of whether it is a better decision to do that, or does it essentially just come down to taxes?
You know, it's taxes, economy, and personal preference. And I throw in the last one because if you are someone who has money in your pocket and you're going to spend it, having that annuity over the next 29 years is probably a better bet for you, because you have the security of knowing, even though it'll be invested on your behalf, it will be there year over year. By contrast, if you're someone who wants to have a little bit more flexibility with your investments, as well as the risk tolerance that you have, you may choose to take the lump sum now, understanding that you're going to pay more upfront taxes, but that comes with the trade-off of having more control over those assets, both how they're invested in the short term and the long term.
And what's the key to protecting your assets when you do have sudden overnight wealth?
You know, think about putting in a plan, and the plan is multifaceted. It's not just an investment plan. It's also an estate plan, which is put into place from a gifting perspective during your lifetime, potentially some irrevocable type of planning put into place during your lifetime or at death. And you also want to think about asset protection. So thinking about insurance, how does that play into your new plan right now, as well as, again, upon your death?
Well, that's certainly, if I do win it, I don't think anyone's going to know. I will carry on life as normal, you know, maybe a little caviar with my lunch once in a while, but everything else for me, I'll keep it pretty low key. A big thank you there to Wells Fargo's Wealth and Investment Management Managing Director for Advice and Planning, Emily Owen. Thank you so much. We have lots of Fed speak today. Vice Chair of Supervision Michael Barr will offer more color on bank capital requirements, while San Francisco Fed President Mary Daly and Cleveland's Loretta Mester are weighing in on monetary policy. Let's bring in Yahoo Finance's Jennifer Schonberger to give us the latest details. Hey, Jennifer.
Hey there, good morning, Michelle. That's right. Fed Vice Chair of Supervision Michael Barr giving a major speech in Washington this morning, previewing how he's looking to strengthen capital requirements for banks with $100 billion in assets or more. Barr saying essentially that those banks with assets of $100 billion to $250 billion could be subject to some of the more stringent capital requirements that the nation's largest banks are already subject to. Barr saying, quote, "Our recent experience shows that even banks of this size can cause stress that spreads to other institutions and threatens financial stability." Notably, banks with $100 billion in assets would be subject to count any unrealized securities losses against the regulatory capital, in effect, raising their capital requirements. Right now, only banks with $700 billion or more are subject to that. That a reaction to the events that triggered the collapse of Silicon Valley Bank, and one that Barr thinks could help protect against such a calamity in the future. Barr estimates the new capital requirements would be equivalent to returning the largest banks to hold an additional 2 percentage points of capital, or an additional $2 of capital for every $100 of risk-weighted assets. Now, elsewhere, Cleveland Fed President Loretta Mester says she thinks rates need to move up, quote, somewhat further and be held at that level. She hinted that the Fed's next move should be to raise rates and then hold them at that level to accumulate more data and survey the impact of the Fed's rate hikes. And also this morning, San Francisco Fed President Mary Daly, speaking in Washington, says she thinks that we're going to probably need a couple more rate hikes over the course of the year. She says the risks of doing too much outweigh the risks of doing too little, though that gap is starting to narrow. Rochelle?
All right, appreciate that update, Jennifer. Jennifer Schonberger there for us. Well, get ready to log into Amazon this Tuesday and Wednesday. Amazon's Prime Day kicks off at 3 a.m. Eastern on July 11th. The sales event, which began in 2015, sees many products going on sale. Last year, Prime members purchased more than 300 million items worldwide, saving over $1.7 billion US. Now, it marked the company's most successful year yet. According to Investopedia, however, the average return during Prime Days is negative. Over the past 8 Prime Days, Amazon has seen a negative 0.34% drop in their shares. And according to analysts from JP Morgan, this year's Prime Day will only generate about $5 billion US of incremental revenue. Now, that would be up 13% from last year, but it does show that the pace of growth has slowed significantly since the company saw a 30% increase back in 2020. And a survey from Bloomberg also suggests that this year might have robust interest, but the average spending will likely be lower by 15%. All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
You're sitting in a lot of client meetings, answering a lot of client emails. What's the number one question that those folks are asking you right now?
It is all about how is AI going to be integrated into everyday businesses, and what is the impact on that for the labor market?
OpenAI is in some hot water. The name at the forefront of the generative AI craze has recently been on the receiving end of several class action lawsuits. Now, technically, an American AI research laboratory consisting of a non-profit and a for-profit subsidiary, OpenAI is most famously known for ChatGPT, which is being used by various companies. Now, what could these lawsuits mean for OpenAI and its partnerships? Let's bring in Yahoo Finance's Dan Howley to discuss this more. Hey, Dan.
Yeah, that's right. We're looking at these lawsuits continuing to pile up against OpenAI and other AI-based businesses around the world. Really, what the key crux of the arguments are is, do these companies violate copyright laws when they scrape the internet, the open internet, that for data that's then used to train their AI models. So, just to take a step back with OpenAI and similar generative AI systems, they go through the internet, basically, pile up information, put it into one kind of, we could just say kind of a box, and then that's basically used for them to then generate text. So basically predicting what the next word after a word would be to basically give you those sentences that seem like they're written by a regular person. The same idea kind of plays out when you're talking about visual versions of generative AI or audio versions of generative AI. So this is something that we're going to continue to see companies kind of grapple with, as well as the courts. Right now, there's no real understanding of whether or not this is actually violating copyright law or not. So there's a number of lawsuits. Sarah Silverman, the comedian and author, is now involved in one with two other authors. There's a number of authors outside of those that are also suing companies. Then there's visual artists and audio artists that are also going ahead and filing suit. And essentially what they're all saying is, look, we didn't give these companies permission to scrape our data to then be used to put together these kinds of models that these companies could then benefit from monetarily. So we are going to go ahead and sue and see where that leads us. There's no real regulations that you can speak to. The government has had hearings about what to do when it comes to AI. A lot of the talk, though, has generally been about whether we're going to get, Skynet-style destruction from AI. And really, this seems to be the more important issue of, copyright material. Then there's disinformation or misinformation, as well as inherent bias in these types of algorithms. So I think the overall, broader Terminator fear is certainly out there, and that's what's getting a lot of attention. But it's these kinds of arguments that are going to be the key to moving forward with AI in the future.
We'll certainly be keeping an eye on that, especially since there have been so many copycats of OpenAI. I'm sure they'll all be watching this outcome closely as well. Our very own Dan Howley, thank you so much. Well, in the past year or so, generative AI has taken the world by storm and has become the most sought-after technological innovation for companies and people. Now, a new report from McKinsey found that generative AI could add the equivalent of 2.6 trillion to 4.4 trillion US dollars across various industries. And a study from Capgemini Research Institute has found that 73% of global consumers trust content that is created by AI. But there are still many misgivings about it and many things that we don't understand about the technology itself. Perhaps that question that best synthesizes the overall worry is, does AI violate privacy rights and intellectual property? Well, our next guest argues that generative AI most certainly does. Let's bring in Clarkson founder and managing partner Ryan Clarkson to discuss his firm's latest lawsuit against OpenAI and Microsoft. Thank you for joining me this morning. So break down first the allegations that you have against OpenAI.
Let me start by saying that AI presents one of the greatest opportunities and the greatest challenges in human history. This is a transformative technology that can do much good in the world, from curing diseases and solving climate change, but we need to do it responsibly. OpenAI and Microsoft have created an AI arms race, and they've released this untested technology into the world without appropriate safeguards. Leading AI researchers, like the godfather of AI, Dr. Jeffrey Hinton, all agree that if we continue on this path, we are putting humanity at risk, both in the long term and in the short term, with risks already unfolding every single day. Things like the proliferation of lies and deepfakes and scams, the erosion of privacy, even widespread job loss. So if you look at OpenAI's CEO, Sam Altman, and Microsoft's former CEO, Bill Gates, they both have signed on to open letters stating their belief that the dangers posed by AI need to be considered with other societal scale risks like global pandemics and nuclear war. We cannot afford to get this wrong. So what our lawsuit seeks is for a freeze on the commercial access and development of these untested and unproven technologies, unless and until the safety, privacy, and property rights of ordinary people can be implemented using a system of human ethics and human values.
So Ryan, then, but how much of an uphill battle is it going to be if, as you said, a lot of this is unproven technology, we don't have much precedent for this, and regulators themselves have not come to any conclusions? Is a class action lawsuit the best way to go about this?
Theft of personal information at scale is not a lawful business model. And that's exactly what these companies have done. They've stolen the personal information of hundreds of millions of Americans, including children of all ages, their creative works, their professional works, their photographs, all of it used to feed an AI model that is unpredictable and dangerous. No one consented for the use of their information in that way, and no one was given an opportunity to opt out. Now, the government, both from the legislative branch and the executive branch, are looking into common sense regulations, except they're not moving as quickly as this technology because they were not designed to do so. So we are going to ask the courts to apply these unprecedented facts and circumstances to well-established property and privacy law.
And what do you think this unlocks? Because I mean, a lot of people were sort of, using it at their companies, potentially putting data from their companies into ChatGPT and putting themselves out that way, on top of also getting data that was scraped without people's knowledge. What sort of snowball effect could this have?
Well, I think it has the potential to be a huge snowball effect. We have been duped by big tech into believing that there is this Sophie's choice that exists. Either we participate online and participate in transacting business and communicating on the internet, but we waive all of our privacy and property rights, or we simply don't engage in activity on the internet. That is a false choice. Simply by virtue of engaging in human life on the internet, we do not waive our privacy or our property rights.
And so with that in mind, I mean, you noted to us that this isn't about having an antagonistic relationship with AI. Obviously, it can do a lot of potential good here. But what is the outcome that you're actually looking for then with this class action lawsuit?
Well, we're looking to come together on this issue. People on all sides of this issue want common sense safety protocols implemented into this technology across government, industry, nonprofits. And this is an opportunity for ordinary people to have their voices heard as well. And thus far, the reaction has been overwhelmingly positive. We've heard from concerned citizens, from other potential class members, from whistleblowers coming forward to share their stories. And I'd encourage all of your viewers, Rachel, to do the same. Visit togetheron.ai to learn more, to take action, and to join our case and our cause.
But I do want to ask, in terms of damages, what sort of recourse is it that your clients are seeking?
Well, our information is valuable and it belongs to us. We need not look any further than the statistic that you just put up before this segment about the amount of money that is being invested into the economy in AI. Look at the young company OpenAI's valuation of almost $30 billion already. Look at the market cap increase of hundreds of billions of dollars for Microsoft since the announcement of their partnership with OpenAI. Big data and our personal information is big business, and it has value. And what we're seeking is compensation for everyone whose personal information was stolen to train these AI models, which would be worthless without it.
Indeed. Good data, good quality data really is the key there when it comes to generative AI. A big thank you there to Clarkson founder and managing partner Ryan Clarkson. Will be keeping track of that lawsuit. Thank you for joining us this morning.
Thank you, Rachel.
All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
The number one question that you are asking yourself right now about markets, maybe one that you don't talk about with clients, one that, when you're sitting there at night, what is the thing you're worried about, or the question you really don't feel like you have an answer to?
It's the question that I do ask constantly. I think it's the one that's not talked about, which is when are we going to go back to looking at cash flow, cash flow, cash flow? It's been a while. It's still multiples of lots of metrics that get adjusted frequently, or they're top line focused. When's the market going to go back to be cash flow focused?
When will we stop doing non-GAAP, whatever?
Fundamentals, all that kind of thing.
Sure.
Yeah, exactly.
Shares of Levi recovering today after a difficult session on Friday. The retailer posted a 22% decline in its U.S. sales year over year and slashed its profit outlook. Levi's CFO Harmeet Singh joined me following the report to discuss these setbacks. Take a listen.
We came into the year expecting this year to be a tale of two halves, with the first half a lot weaker than the second half, essentially because we were lapping strong growth from a year ago. We were implementing an ERP, and commodities, cotton in the first half was pretty high. And a tale of two worlds, with the Western world slightly softer, the Eastern world and Latin America, fairly strong, and a tale of two channels. Our direct-to-consumer business, which is our stores and e-commerce, and the best expression of the brand, strong, with the wholesale business largely weaker. As we exit the first half, a couple of things. We have delivered on our, quarter two commitments and our largely first half commitments. We were up, we were flat to a year ago, but up 10% relative to 19. The headwinds, like ERP is implemented, commodity pressures have abated, and the second half is being set up much stronger, as well as our direct-to-consumer business is up, double-digit on top of double-digit growth from a year ago. Going back to the question about the full-year guidance, as we exit the first half, we have grown market share in the U.S. Men's is up, women's, where we were, number 3 a couple of years ago, we're number 1. And we're taking actions to address U.S. wholesale. We're taking some surgical, price reduction on a handful of fits. Our supply chain has got a lot more efficient. And inventory levels have come down dramatically. And, we said we'll end the year with inventory levels below last year levels. And so we're basically setting up, 23 and the second half where we will grow mid-single digit and exit 23 in a much stronger position and laying the foundation for a strong 24.
We know that a lot of investors, they were looking at that data, but they were also a little bit concerned about that net loss for the quarter of 1.6 million. Obviously, something we hadn't seen since pre-pandemic there. So in terms of the long play then with direct-to-consumer, is that still going to be the committed focus there versus any more reliance on third-party sellers?
Yeah, as we've expressed strategically, our direct-to-consumer business is today about, a little over 40% of our business. It was, half this a decade ago when Chip and I joined. And our slated goal is for this business to be the majority of the business going forward. We have great retail customers, and so the company is going to be a hybrid company from a channel perspective and actually grow distribution with both customers. But the direct-to-consumer businesses represents the full expression of the brand. The chambray shirts that I'm wearing, the denim bottoms, a non-denim business, etc. If you go to our stores, you find a head-to-toe look, as well as the interaction and engagement with store staff, the tailor shop, etc. is how why we believe the consumer engages a lot better in our direct-to-consumer business, as well as our e-commerce business, which was up 20 odd % this year and is still underpenetrated.
That was Levi CFO Harmeet Singh there joining us. Well, let's get you a final check of the markets as we head into the noon hour. Still looking at a mixed picture here, although at least the S&P has just slightly turned positive there, but still a mixed picture here. The Dow up about 150 points, or about 0.4%. The S&P 500 there up ever so slightly, about 2 points there, just barely in the green. And the tech-heavy Nasdaq, the FANG stocks really under pressure today, except for Meta. And right now, that's down about 21 points on the day. A lot of pullback here as we see ahead of some big inflation prints that we have coming up this week. Consumer Price Index out on Wednesday. Producer Price Index, which measures wholesale price pressures, that'll be coming out on Thursday. And of course, the big banks getting ready to kick off the second quarter earnings season. So we'll be keeping an eye on that for you as well. Well, that does it for now. I'm Rochelle Akufo, but I will be back with you at 11 a.m. Eastern. Until then, stay with us on Yahoo Finance.